Okay. Good morning, friends. Good morning, friends. Okay, let's now move to advanced capital budgeting decision, which is a new addition in your syllabus. Now, in advanced capital budgeting, I said there are two parts to the advanced capital budgeting. One, which you learn at CA Inter, which is the basics part of it, and second, which you're going to learn additionally here. So, I have broken down the syllabus into 10 subparts are 11 subparts, which starts with basics, investment decision. These two are technically part of CA Inter, basics and investment decision, where I may not discuss even one question, but I'll discuss the concept alone. And I had told you to go through the concept before. I had told you that you go through those concepts before, because whatever you learnt at CA Inter is what is going to be tested here. And most of the questions there are what you could have done at CA Inter. I would have picked the questions from there and put it here. Our focus at CA Final is on replacement decision. Even long-term funds versus equity approach is not that critical because you do it in valuation. FCFF versus FCFE is that. APV, inflation, NPV, standard deviation, all these are new additions at final level. In fact, some of this you could have seen even at inter level, because earlier at CA Inter we had a chapter called risk analysis and capital budgeting. They have removed that and now they have migrated that to final. So that is what they've ended up doing. So risk analysis and capital budgeting, which you could have done at CA Inter, may have covered these areas. For some people, risk analysis and capital budgeting would not have been there. And the current CA Inter, they've removed this concept of risk analysis and capital budgeting at CA Inter. So we technically going to focus on replacement decision till option in capital budgeting. That's the area we're going to focus on. Now, in order to do this, let's first quickly go through the basics. We learned that there are 6 techniques of capital budgeting, starting from payback, discounted payback, NPV, profitability index, ARR, which is on average investment, and initial investment, and IRR. These are the 6 techniques we have. In IRR, I have another technique called modified IRR. What is payback? Payback basically refers to the time period in which you are able to recover the initial investment without considering the time value of money. I do not give weightage to the time value of money concept. I just put the cash flow, initial outflow negative 2 lakh. You keep getting 20,000, 30,000, 40,000, 50,000, keep getting inflow. As long as you get back your, you wait till as you get back your money. Once you get back your entire 2 lakh rupees without giving effect to time value of money, payback is attained. Payback gets attained moment my initial outflow is fully recovered. So payback refers to the number of years taken to recover the initial investment. It ignores the time value of money. There's a formula. Formula is very simple. We calculate something called as a base year. What is base year? Is the last year in which cumulative cash flow is negative. If cumulative cash flow is negative, what is cumulative? Outflow and inflow put together. If it is negative, means payback is not yet achieved. So last year when it's negative, from negative when you move to positive, payback is achieved by the organization. An example was starting with minus 10 lakh. We keep putting these numbers here. This is the base year. Last time when the cumulative cash flow is negative, then how much negative? 50,000. How much next year? 2,50,000. So 2 plus how much negative divided by the cash flow of the next year will give you the payback period. Next come discounted payback. Exactly same thing, just that you will have to do PVF, DCF. You will have to do PVF and DCF. Because of this, you will calculate cumulative discounted cash flow. Formula remains the same. Base year plus unrecovered discounted cash flow of base year. Unrecovered discounted cash flow of base year divided by discounted cash flow of next year. Same example. Here my base year again continues to be year 2. Base year continues to be year 2. The amount of negative is on the higher side, 177. Next year, no discounted cash flow. Only discounted. Don't look at the normal cash flow. Only look at the discounted cash flow. NPV is present value of inflow minus outflow. Nothing much for me to talk about this. Most commonly used method for doing all our problems. Profitability index, otherwise called as benefit cost ratio, otherwise called as present value index, otherwise called as desirability factor, is the ratio of benefit to cost. Benefit cost ratio is the ratio of benefits. What is benefits? Inflow. What is cost? Outflow. So PV of inflow divided by PV of outflow. One good example, NPV of the project is 2 lakh. Outflow is 10 lakh, which means my inflow is 12 lakh, which means my inflow is 12 lakh. NPV is 2 lakh. Outflow is 10 lakh, which means my inflow is 12 lakh. Profitability index is inflow divided by outflow. 12 lakh divided by 10 lakh. 12 lakh divided by 10 lakh. Accounting rate of return. This is the only technique which focuses on accounting data. All other technique focuses on cash flow. Why we focus on cash flow is cash flow cannot be altered, by a person by just playing around it. When I say playing around it, for example, profits I want to increase, do WDV method, do SLM method, or you go for provision for bad and doubtful debt write off, don't go for provision for bad and doubtful debt write off. So you can keep doing multiple things in accounting to change your profits. Cash flows cannot change just because of your accounting. We have a direct method of calculating cash flow and an indirect method of calculating cash flow. You would have learned that in cash flow statement. So indirect method may look like that it is based on PAT. No, it is starting with PAT, but working capital changes, everything is factored in that. So cash flow is what is very critical. Cash flow cannot be altered by a person. If you want also, you cannot alter the cash flow of a company, but you can easily alter the profits of a company by changing certain methods. If you just play around the methods, WDV versus SLM, FIFO versus LIFO, weighted average. So that is why profit is not critical. But still one technique talks about profit. A rate is equal to what I get back divided by what I give. So what I get back is profit. What I give is investment. There are two names for investment. One is called initial investment. Second is called average investment. Initial investment is what you invest on day zero. What is average is, if you invest 20 lakh rupees on a project, first year you get back something. Second year you get back something. Third year you get back something. Fourth year you get back something. Fifth year you get back something. So you cannot say at any point of time 20 lakh is stuck. So instead of doing every year investment calculation, every year how you can do investment calculation, 20 lakh, for example, in this question, this is my first year investment, 10 lakh. Second year investment is 5 lakh 9950 because I've already got back 4 lakh 9000. Third year investment is one, not this, okay. Let me see, because without time value of money, 10 lakh, 5 lakh 50, negative 50, then investment itself is not there because my investment has come back. So instead of doing all this yearly calculation, they say take your initial investment, take your closing investment and divide by 2. How will you take your closing investment? Closing is equal to scrap value. If scrap value is not given, closing is equal to 0. Closing is equal to 0. So initial plus opening plus closing by 2. Opening is equal to what you invest. Closing is equal to salvage value. Closing is equal to salvage value, which can be 0. Initial investment 5 lakh. Salvage value 1 lakh. Average is 3 lakh. Average profit is 1 lakh. ARR on average investment 1 lakh divided by 3 lakh. Internal rate of return, IRR, is the rate of return at which NPV is going to be 0. So in order to calculate IRR, we need one positive NPV and one negative NPV. We may have to start with some random rate, high probability. Below the question they'll give you some rates. From there you start your calculation. Get one positive NPV, one negative. If you get a positive NPV, increase the discount rate. If you get negative NPV, reduce the discount rate till you get one positive, one negative. Whenever you do IRR calculation, year, cash flow, PVF, DCF, leave space to do another PVF, DCF, at least 3 times NPV we should be able to calculate. Moment you get one positive and one negative, either we use the interpolation technique or you use the timeline approach. Interpolation, or the formula is the lowest rate L1 plus how much NPV you generated at that rate divided by the difference in NPV into the difference in rates, If you are getting a positive NPV, this should ideally get tested in exam. If you get a positive NPV, it means your IRR is more than the cost of capital. And if you are getting 0, IRR is equal to the cost of capital. And if you are getting negative, IRR is less than cost of capital. Now, we need that initial rate to start with. If below the question they give you some rate, start with. Otherwise, you need to do, this is just a guess calculation, may not be always accurate. In exam situation, in the calculator, you will have to do ARR on average investment. What is ARR on average investment? You'll have to add up all the profits, divide by the number of years, take the average investment, do ARR on average investment, and 2 by 3 is the approximate initial guess rate. Is the so if you do 2 by 3 and you get 12.27, your wish you round off to 12, 13, any number you round off and then start doing your calculation. This is just an approximate number to start our calculation, approximate number to start our calculation. Assuming the question has already given you below the table, no approx calculation, just start with what is there below the table and then keep doing it. One place you can use a short method for calculating IRR, which the formula is nothing but future value is equal to present value into 1 plus R the whole power n. Future value is equal to present value into 1 plus R the whole power n. Now in this formula you need one outflow, one inflow. Don't tell multiple outflow, multiple inflow, only one outflow and one inflow, and number of years should be 2, 4, 8, 16, 32. Why this? Because you can keep taking square root and then come downwards. Power 6 means you cannot take a square root, because with square you need to take a cube root. There are certain calculated techniques where even power 6, power 7 can be calculated. I'm not getting into it. But if you have power 2, power 4, power 8, you can try to do it. For example, NPV at a discount rate of 10% is 1250. 11% is minus 200. IRR, timeline approach, 10% 1250. 11% minus 200. The difference here 1450. The difference here 1%. So what we are saying, 1% change in discount rate will lead to 1450 change in NPV. 1450 change in NPV. 1% equal to 1450. Question mark equal to 12. That is, how will 1250 become 0? How will 1250 become 0? 1 equal to 1450. Question mark equal to 1250. What's the question mark? So 12 plus 0.86 is the IRR. 12 plus 10 plus 0.86 is the IRR. The same thing can be done in formula also. The same thing can be done in formula. Next, initial outlay of a project is 50,000. Aggregate inflow, one inflow, 1,04,896. How much is the MIRR? MIRR is modified IRR. I'll discuss. Calculation remains the same. How will we do this? Is future value is equal to present value into 1 plus the R power n. I am getting 1,04,896 equal to 50,000 into cost of capital is of no use to me. Okay, cost of capital is of no use to me. It is used to calculate MIRR, but as of now it's of no use because the future value is given. You divide by 50,000. One square root will make it 1 plus R square. Another square root will make it 1 plus R. Do and tell me. Divide by 50,000. 104,896 divided by 50,000. One square root, another square root is 1.2035. 1.2035 is equal to 1 plus R, is equal to 1 plus R. R is equal to 20.35%. Clear? Next example. Annual cost saving is 40,000. IRR is 15%. Profitability index is 1.064. What is the NPV of the project? This kind of covers a lot of things here. Now, I save 40,000. IRR is the rate of return at which NPV is 0. That does not mean NPV becomes 0. That does not mean NPV becomes 0. So, whenever you apply IRR, PV of inflow and PV of outflow will be same. PV of inflow and PV of outflow is going to be same whenever we apply IRR in the formula. Whenever we apply IRR in the formula. Now, the other thing is present value of outflow is today's outflow, whether you do 10%, 12%, 14%, 18%, 20%. Sorry, are others facing an issue? Okay, it should be better now. So, my PV of inflow can keep changing as you change the discount rate. PV of inflow, if you change the discount rate, the value will keep changing. PV of outflow does not change based on discount rate because it is today's value. How will it change based on discount rate? So here, if I apply IRR here, cash flow, PVF, DCF. What's the IRR rate they've given? 15%. So if I put this year 0, 1 to 4, what is the inflow they have mentioned? Annual cost saving. Tell me 4-year annuity factor. 15% 4-year factor. 1 divided by 1.15 equal 2 point. This is going to be 1. This number is this much. This number is this much. And you get this is PV of outflow. This is not PV of inflow technically. This is not PV of inflow technically. Why this is not PV of inflow? Because this was done at 15%, whereas the cost of capital can be 18, 20, 12, 5, 4. It can be anything. It can be anything. Is this right? Why I am saying this is right? Because my NPV is going to be 0. At IRR, my NPV is going to be 0. So indirectly balancing figure is negative 114, 200. Balancing figure is negative 114, 200. Is this discount rate right? No. It should be 12, 13, 14. I don't know the number. You change the discount rate. Will this number 1 change? No. So 114, 200 is present value of outflow. That is not present value of inflow. Then how do I get present value of inflow? What is the formula for profitability index? PI is equal to PV of inflow divided by PV of outflow. You will get PV of inflow now, and then inflow minus outflow will give you the NPV. Inflow minus outflow will give you the NPV. Again, I am repeating, our present value of outflow can never change based on discount rate. Can never change based on discount rate unless an outflow is happening in the first or second year, which is a rare scenario. In that case, it can change. So here, if you see the calculation, first we used the IRR approach, got the present value of inflow, which is equal to present. Ideally, I should have used the word, this is not PV of inflow, this is equal to PV of outflow. This is equal to PV of outflow. We are using this PV of outflow later. We are using this PV of outflow later to get the PV of inflow and then getting the NPV. I can also tell you one more thing. What is the profitability index? Which means NPV is 0.064 into the cost of project. NPV is 0.064 into the cost of project. Cost is 1, extra is NPV. Extra is NPV. 0.064 into 114,200 is how much? No, 0.064 into 114,200. 7,309. Okay. Next, what discount rate do I use for project evaluation? The best approach is to go for cost of capital, but the problem is the cost of capital which is there today can change also. Cost of capital today, we don't use cost of equity. Here also you will learn about two approaches, FCFF approach, FCFE approach. FCFF cost of capital, FCFE cost of equity. So cost of capital is the normal approach, but in a rare scenario, the discount rate can keep changing. 10 becomes 12, 12 becomes 14, 14 becomes 16. In case there is a change in discount rate, extreme caution is needed. PVF of year 2 is not equal to 1 divided by 1.122 times. Is not equal to 1 divided by 1.122 times. It is equal to, sorry, yeah. It's equal to 1 divided by 1.10 first, then divide by 1.12. You want third year factor, 1 divided by 1.10, then 1.12, then 1.14. You will have to keep dividing by, the newer rate. Any doubts in this? Go through this example. Tell me what should be the discount rate here. Think and let me know. RF plus beta into RM minus RF. What is RF? Okay, beta. I'm least bothered about the company beta. I'm only bothered about the project beta. 1.2. RM. Least bother about what happened in the past 12 months. I'm only bothered about what is going to be in future. Clear? Any doubts on this? So 13 minus 8. Now listen, discount rate for year 1 is 15%. Second year is going to be 16. Third year is going to be 17. Tell me what will be the PVF of year 3? First year 15, second year 16, third year 17. What is the PVF of year 3? 0.6. Okay, let others complete. I don't know the answer. If it increases every year, you cannot do 1 divided by 1.171717. That's not possible. First, do 1 divided by 1.15. Then do divided by 1.16. Then do divide by 1.17. 0.641. There are certain rules for calculation of cash flow. Again, may not become very critical for us. Some of this you would have done at CA inter level. Some of this may come in international capital budgeting. In international capital budgeting, they may ask you to calculate the cash flow. So certain rules is, one is depreciation, non-cash item, but still I'll have to consider because of the tax angle. So we'll have to deduct depreciation and add back depreciation. Opportunity cost. If there's any opportunity cost given in the question, you'll have to consider that as an outflow in your cash calculation. Example, rent on own building, salary of proprietor. Some question will say, I can earn a pre-tax rent of 20 lakh. Please deduct before PBT. Some question will say, I can earn a post-tax rental income of 12 lakh. Deduct it after PAT. Deduct it after PAT. If the opportunity cost is opportunity cost before income tax, do before income tax. If it's after income tax, do it after income tax. So, guys, please be on mute. Please be on mute. Opportunity cost is given pre-tax, deduct before PBT. Opportunity cost is post-tax, deduct after PAT. Again, I'm repeating, some of these rules were very, very critical at CA inter level. Final, if they want, they can end up asking it, which is where segment 1 and segment 2 of our material is there, where I think we have a lot of sums. But if you see none of those sums, I would have marked revision because they are not part of my last 10 RTP, last 10 MTP or study material. So I have not made them as a question in my revision. I would not be discussing them, but they are technically something which ICA can test. Sunk cost. What is sunk cost is which has already been incurred by an organization and which does not change based on the decision you're taking. A classic example, I want to put a project in Chennai. For putting a project in Chennai, I'm telling somebody to give me a market survey report. So he goes to every home, does some survey and gives me a report. I have to pay him 1 crore rupee for that. This 1 crore is a sunk cost. This 1 crore is a sunk cost in deciding whether to do the project or not. Reason is, if you do the project, you have to pay 1 crore. If you don't do the project, also you have to pay 1 crore. Assume my agreement is like this, that you give me a first report. Based on that, I will decide to do the project. I'll pay you 1 crore. But if I decide not to do the project, I'll pay you only 40 lakhs. If at all I have an agreement like that. If at all I have an agreement that if you give me the report and it works for me, 1 crore. If it doesn't work for me, 40 lakh. Nobody will enter into, because then there will be a conflict. So he may end up giving a good report. So 1 crore minus 40 lakh is relevant. 1 crore, always it's yes minus no. If you do the project, what happens? If you don't do the project, what happens? The difference is called relevant cost. Relevant cost, no opportunity. 40 lakhs is sunk cost. Overheads, some question will use the word apportioned overheads, general overheads, corporate overheads, distributed overheads. All these are irrelevant. All these are irrelevant. Then what is relevant? Anything which is specific to a project. Anything which is specific. For example, I am taking this batch now. Because of this batch, we are incurring extra electricity cost. That is relevant. But we are also incurring rent because of the batch. We are also incurring rent because of the batch. That is irrelevant, because my team will distribute rent cost even for this batch. But even if I had not taken the batch, I would have paid the rent. I would have paid the rent. So rent is an irrelevant cost, but electricity is a relevant overhead. Electricity is a in the electricity also some part of electricity is irrelevant. Even if I had not taken the bath, some electricity would have been consumed. Some extra whatever I am consuming only is relevant. Working capital we have already discussed when I did there. Changes in working capital. Changes in working capital is a relevant expense. Is a relevant expense. Increases outflow, decreases inflow. Reward exclusion principle. This is what that FCFF and FCFE says. What is reward exclusion principle is? If you do evaluation for FCFF, what is FCFF? Is long-term providers of money, which is what we normally do. What reward you pay them? Interest to debt guys, preference dividend to equity, preference guys, equity dividend to equity guys. All this is ignored in cash flows. All this is ignored in cash flow. Then where do we consider? In WACC calculation, and you do discounting, So discounting automatically takes care of the reward to be paid to the providers of capital. Discounting automatically takes care of the reward to be paid to the providers of capital. Clear? Any doubts on this? Some question we will use only equity shareholders approach, which is called FCFE approach, In that case, equity dividend is ignored, interest paid considered, repayment of loan considered, like you were doing FCFF and FCFE approach. Incremental principle is our focus should only be on extra item, not on anything which is generally there. For example, just to give an example, I have taken this batch. If I had not taken this batch of classes, 80 students of mine would have cleared, let's assume. Because of this batch, 100 students are going to clear. So the benefit of this batch is extra 20 students clearing, and not saying that entire 100 students have cleared just because of this batch. So what extra is this contributing towards the results? So because of this match, I would be getting extra 40 students. Otherwise, I would have got 200. Now I'm going to get 250 students in the next 1 year. So what extra am I getting is only the benefit out of this and not overall. You cannot say that overall profit is because of this project. An example I said, simple rule for identifying something as relevant or not. A company will incur marketing expense of 40 lakh if they take up a new project. However, the same will not be incurred in case they are not doing the project. As of now, you are yet to incur the expense. You say you are doing the project, go ahead and incur marketing expense. Not doing the project, don't incur marketing expense. Yes, incur. No, don't incur. Relevant. No, don't. Next, a company has incurred market survey of 10 lakh. Yes, already incurred. No, already incurred. Irrelevant. It is irrelevant. A new project has been apportioned. I'll tell you, our classes has been apportioned electricity cost of 100 lakh. Electricity costs include apportionment of what? General electricity charges, except to the extent of insurance charge of 10 lakh per annum payable on this venture. That is because of this classes, there is something extra which is happening. How much I got distributed? 100 lakh. I got distributed 100 lakh, and the question says factory overheads include apportionment of general factory overhead. If you just stop at this, no, zero is the relevant cost. Except to the extent of what? Insurance charge of 90 lakh payable on this venture. So if you do the project, cost is 100. If you don't do, cost is 10. Why 10? Because this 90 would not have been incurred. So 90 alone is specific. Tell me in this example, what will happen? How much is the initial working capital? 20 lakhs. In first year, what will happen? Outflow of 5 lakh. Second year, decrease to 22 lakh. Inflow of 3 lakh. From 25 minus 22. 3 lakh. Third year they can give, fourth year they can give, fifth year they can give. You can keep going on that. Company has invested 2 lakh in conducting a market survey to assess the response to a new product. In accordance with the survey finding, company wants to spend 10 lakhs on machinery, 4 lakhs on working capital. What is the initial outflow? On day 0, how much total we are paying? 2 lakh. Market survey? That's a sunk cost because doesn't really matter. You have already incurred it. Hospital is contemplating acquisition of a diagnostic machine which is expected to generate an after-tax cash flow of 80,000. Currently, I am outsourcing and earning a commission income of 20,000. Applicable tax rate is 40%. How much is the incremental CFAT due to the new machine? What is this 20,000? It is opportunity cost, because what used to do is when you were going to hospital, they're writing some scan and telling you to go to someone else. He was giving me commission income of 20,000. Now because of this diagnostic machine, I'm going to earn 80,000. Opportunity cost is 20,000. How much is the CFAT? It's not 80,000 minus 20,000. I told you opportunity cost before tax, after tax. Wording used is what? Commission income of 20,000. They have never mentioned that this is before tax or after tax. Normally it is before tax. Normally it is. If I tell I earn a rental income of 1 lakh, you will understand rental income is before income tax. So first I convert this 80,000 divided by 0.6. How much? 80,000 divided by 0.6. Subtract now 20,000. Now subtract tax. This is one way of doing. Other way of doing is 80,000 leave as it is. Convert the 20,000 into after tax. Convert the 20,000 into after tax, which is 12,000. Convert 20,000 into after tax, which is 12,000. So 80 minus 12, 68. 80 minus 12, 68. Go through this. You need to tell me as per your income tax understanding. Go through this and tell me as per income tax understanding. What does block of assets method say? Sorry? Entire block should be sold, otherwise no capital gain, no capital loss, unless the sale value of one asset is even more than the block value itself. The sale value of one asset is more than the block value. I am following a block of assets method. It has several other machines in the block, so block will not cease to exist. Block will not cease to exist. Company is selling an existing machine with a book value of 3 lakh for 5 lakh. I'm selling an existing machine of 3 lakh for 5 lakh. No income tax will come on this. No income tax will come on this because it is not short term capital gain. It will purchase a new machine for rupees 10 lakh. It will purchase a new machine for rupees 10 lakh. Just an imaginary number, okay? Today the block value is 100 lakh. Just an imaginary number. If somebody is saying no, block value is very less, then it's a different story. So in this 100 lakh, I'm selling an asset for how much? 3 lakhs asset for 5 lakh. From block 5 lakh will get removed. From block 5 lakh will get removed. It will become 95. And then in the block, how much will get added? 10. So block will now become 105. Block will become 105. All this is your income tax angle. All this is your income tax angle. No capital gain. No capital gain. So no tax payment and all. Why no capital gain? Very clear calculation. Because I do have other assets in my block. What is the extra depreciation? Earlier 100 lakh into 10%. Now 105 lakh into 10%. Now 105 lakh into 10%. So extra is how much? 50,000. Extra is 50,000. Nil tax paid and depreciation of 50,000. Company will not pay tax as there are other assets in the block. Incremental WDV is WDV will go up by 10 lakh, go down by 5 lakh, extra 5 lakh. On that extra 5 lakh, 50,000. Any doubts on this? Next, steps in computation of cash flow. When you calculate your cash flow, we normally follow 3 steps. Initial outflow, in between flow, terminal flow. Initial outflow, in between cash flow and terminal flow. What is initial outflow is capital expenditure and working capital. Some money is stuck in capital expenditure, some money is stuck in working capital. Apart from this, some question can say you got some subsidy income, you got some government grant, you paid some compensation. All this can happen on day zero. Whenever these extra happen, think income tax about it. Think income tax about it, because it may have tax impact. It may not also have tax impact. There may be some other items such as installation charges will not have any income tax impact, because installation charges will get added to the cost of the asset. If you pay any compensation, you may get tax benefit on that. You may get tax benefit. We should capture only the amount which has been paid on day zero in initial outflow. Sometimes what will happen is you bought a machinery worth 100 lakh but paid only 80%. Capital expenditure is only 80 lakh. Capital expenditure is only 80 lakh in day zero. Where will balance 20 go? In your in between cash flow. In your in between cash flow. In between cash flow, start with how much extra revenue you are making, how much extra cost saving. Any saving in cost is like a revenue. Any saving in cost is like a revenue. Deduct all cost other than depreciation or with depreciation. That's your wish. If you deduct without depreciation, it's called PBDT. Many a times what I do is I deduct even with depreciation and directly give PBT, directly give profit before tax. Then you deduct tax, profit after tax, add back depreciation, working capital changes, any new capex, and in case you have made any payment for your original machine. I said you would not write the entire amount there. So any extra amount you paid will come here. Incremental means only the extra revenue generated or extra cost incurred. This is because company would have earned some revenue even without the new project. As I said, because of this project, how much extra benefit, because of the CA classes, how much extra benefit is coming to you or to me needs to be measured and not the overall number. What is terminal flow? First is net salvage value of your capital expenditure, and second is recapture of your working capital. Every year working capital gets stuck. In the end, it will get released. In the end, it will get released. On the capital expenditure, what will happen is you will sell it. You will sell it. So on the capital expenditure, we'll have something called as sale value compare with book value. We have sale value compare with book value, that can result in capital gain or capital loss, on which there can be a tax paid or tax saved. And finally NSV. What is NSV? Sale value plus tax saved minus tax paid. Sale value plus tax saved minus tax paid. Example is a very important thing. Sale value is 1 lakh, okay. Book value is 50,000. I make a capital gain of 50,000. I make a capital gain of 50,000. On the capital gain of 50,000, we need to pay income tax at the rate of 40%, which is 20,000. What is NSV? Is this 1 lakh and this 20,000. Many students in a hurry think it is continuation and do 50,000 minus 20,000 and write 30,000. It's not continuation. There's a line gap in between. Your what is net salvage value? Sale value plus or minus tax. Sale value plus or minus tax. So 1 lakh minus 20,000. 1 lakh minus 20,000, you get 80,000. If both are same, no income tax, 50,000. Sale value 0, but still there can be a net salvage value. Sale value is 0, but still there can be a NSV. There can be a NSV because book value is 50. There's a loss 0 plus the tax saved. If sale value is equal to book value, there is no tax. Sale value is equal to NSV. Some question will say ignore tax on capital gain. Don't do any calculation. Sale value is equal to net salvage value. If sale value is 0, this does not mean NSV is 0. This does not mean NSV is 0. If resale value is equal to cost of removal, some question will say project got over. You want to sell the machinery. For selling the machinery, you will get 1 lakh rupee. But to take it out from your factory to outside, you have to spend 1 lakh. You have to spend 1 lakh transportation cost. So if resale value and cost of removal is same, sale value 0, net salvage value depends on the calculation. Net salvage value depends on the calculation. Do this example and tell me what is the initial outflow. Guys, please do calculation. I want you to do the calculation. Tell me what's the initial outflow. How much? ABC is considering replacing of its outdated machine with a new machine, which comes with a price tag of 5 lakhs. Existing machine will be sold for 1 lakh. So net 4 lakh. As part of the upgrade, all current utilities is related spares, which you will need another 2 lakh, and your old utility will be sold for 20,000. So net it is 5 lakh 80. Tell me this. This is in between flow calculation. My inflow is 2 lakh of saving and 4 lakh of saving. Outflow is 3 lakh. Depreciation 2 lakh. Profit before tax is 1 lakh. Profit before tax is 1 lakh. Deduct income tax. Profit after tax is 70,000. Add back depreciation. Add back depreciation. Do this. What's the answer? A machine can do two things. Either it can save cost or give you revenue. It is giving me a revenue of 5 rupees net. What is 5 is 20 minus 15, and also saving 2 rupees for me. Also saving 2 rupees for me. What is 2 rupees? I incur a cost of 2 per ton to dispose. 2 per ton to dispose. So I have saved 2 rupees, earn 5 rupees, put together 7 into 1 lakh. Put together 7 into 1 lakh. Some question will say asset is purchased at the beginning of the year. Our capital budgeting assumes everything to happen only at the end of the year. Does it mean everything will happen at the end of the year? No, this is just to do simple calculation, because the PVF which you use, no, that is the end of the year PVF. The PVF which you use is end of the year present value factor. Somebody says no, everything Jan, Feb, March, I cannot do all those calculation. So to make it simple, we do end of year calculation. Now, if you are buying anything at the beginning of the year, then purchase of asset at the beginning of year 10 is end of year 9. Write the cash flow in the 9th year. Write the cash flow in the 9th year. Capital budgeting assumes that cash flows will happen at the end of the year. However, some assets could be purchased at the beginning of the year, and these cash flows will be considered in the earlier year. Example, purchase of asset at beginning of year 5 is equal to end of year 4, is equal to end of year 4, and this cash flow will be considered in year 4. This cash flow will be considered in year 4. Impact of losses. Losses has some significant impact. Whenever an organization suffers loss because of a new project, I'm talking about a new project, not overall loss, okay? Because of a new project, it can save income tax for the company. How can it save income tax? If my other projects are making profits, I'll set off this loss against the other profits and reduce my tax outflow. Any reduction in outflow is an inflow for us. Any reduction in outflow is an inflow for us. Now, this tax saving can be in multiple ways. First approach, all businesses are loss making. All businesses are loss making. No tax saving immediate, but maybe carry forward to future and save tax in the future. Carry forward to future and save tax in the future. So either you can get immediate tax saving or tax saving later, or you get nothing, Example, PBT first year negative 80, year 2 50, year 3 120, year 4 110. Tax rate is 30%. Loss of any year will be set off from the profit of subsequent 2 years. What is the PAT of year 3? Can you tell me how much income tax you will pay in year 3? This is the data. How much income tax you are going to pay in year 3? Minus 80 is there. 50,000 is gone. Another 30,000 is still left over. That is written off. 90,000 is your profit of before tax. Taxable PBT is 90,000. On that you pay 30%, which is 27. This 27 will be subtracted from 120. My PBT does not go down. My taxable income goes down. My taxable income goes down. Some question will say a company has a tax exemption on 20% of profits, 40% of profits, 30% of profit. Two approaches. One is a lengthier approach, another one is a easier approach. What is a lengthier approach? Every year PBT, do a separate calculation, remove 20% from there and then apply. So PBT is 100, remove 20 from this, make it 80, make it 80 and then say 80 into 30% is income tax 24 and bring this 24 here. Second easier approach is my tax rate is not 30%. My effective tax rate is 30 into 1 minus the exemption percentage into 1 minus the exemption percentage. See, your income tax rate could be different. My income tax rate could be different depending on the slab you are in. Similarly, some company may not be paying entire 25%. 40% of the profit is exempt. So their effective tax rate is 25 into 1 minus 40. 25 into 1 minus 40. If you do not pay any expense in the year of incurrence, doesn't really matter. For income tax, it is an allowed expense. So till PAT, no changes. Till PAT, no changes. If you do not pay anything, it is a current liability. It is a current liability. Current liability will come as part of working capital adjustment. Current liability will come as part of working capital adjustment. If you don't pay anything, your working capital will go down. How does working capital go down? Because working capital is current asset minus current liability. If you create current liabilities, working capital goes down. Any decrease in working capital is an inflow in our calculation. Is an inflow in our calculation. So automatically it will be considered there. Unpaid expense will be reflected as current liability and would be factored where? Working capital adjustment. Sometimes what happens is you get a subsidy or a grant from a government. You get a subsidy or a grant from a government. If government gives you a subsidy or a grant, there are two types of subsidy. One is capital subsidy and revenue subsidy. Revenue subsidy is considered in between cash flow, either before PBT or after PAT, depending on whether that subsidy is taxable or exempt. Capital subsidy is considered in step 1 initial outflow. You consider that, but it has one implication. The capital subsidy can be adjusted with the cost of the asset. If you adjust with the cost of the asset, lower depreciation in future. Lower depreciation in future. If you don't adjust with the cost of the asset, normal depreciation in future. Question will not clearly specify the treatment for capital grants and will have to take an assumption. If the grant is adjusted, then it will lead to lower depreciation expense. Clear? Any doubts on this? Any doubts till this? These are your basics which is covered in segment 1 and segment 2 in the question bank. If you see in those questions, I would not have marked revision. In the PDF you will see it's not there in your printed one, but I would not have marked the word revision there because they are not part of study material or the past exam questions. So those are CA inter question. Why I need clarity? Because capital budgeting is also there in international capital budgeting, in international financial management, and even in normal capital budgeting, ICI may end up testing on cash flow calculation. May end up testing on cash flow calculation. Now let's come to the final part of it. In that, ICI material had one thing called as concept of utility value. Problem is very simple. There's no major discussion needed. What they are saying is you're going to generate some cash flow. If you are generating some cash flow, what ideally I want to do is I want to calculate NPV, positive, go ahead, negative, reject it. They're saying no, for the cash flow I'll give a utility value. What is utility values? If utility value is high, it means it is more important for you. Utility value is less, it means it is lesser important for you. So they attach some utility value, attach some probability. Final utility value is weighted average of the various possible utility value with probability being the assigned weight. With probability being the assigned weight. Wherever probabilities are there, we have to take weighted average. Wherever probabilities are there, we have to take weighted average. So what ICA ended up doing is, let's see this. This basics of capital budgeting, there are lots of questions. I think you may have some 4 or 5 questions in this basics. All this for your better understanding. Investment decision, again all these are CA Inter question. I've just copied from CA Inter and moved it here. Maybe 1 or 2 question could be CA final, but predominantly everything is CA Inter question. Now why I want you to go through them, because in exam if some question comes like this, I don't want you to struggle there. I don't want you to struggle. So that's the reason. Okay, this is the question on utility value. Jumble Consultancy Group has determined the relative utilities of the cash flows of 2 forthcoming projects of the client company as follows. That is, if you generate negative 15,000, your utility is negative 100. Negative 10,000, your utility is minus 60. Project A, let's calculate. Utility value is equal to project A is equal to right. Project A is equal to minus 15,000 means how much utility value? Minus 100 into 0.1. Minus 10,000, what is the utility value? Minus 60 into 0.2. 15,000, what is the utility value? 40 into 0.4. 10,000, what is the utility value? 5,000, what is the utility value? I don't know why they want to even test something like this. That's all. You do a weighted average, you're done. Do a weighted average, you are done. This is called utility value calculation. This is called utility value. Project A 2, project B 17.55. Go ahead with project B. Go ahead with project B. Weighted average of the various possible utility values with probability being the assigned weight. With probability being the assigned weight. This is called expected utility calculation. Any doubts on this? Can you proceed? Okay, a small discussion again on FCFF and versus FCFE. We've already done this earlier also. FCFF discounts are technically called as long-term funds approach. FCFF is technically called long-term funds approach. FCF is technically called equity shareholders approach. FCF is technically called equity shareholders approach. Whatever FCFF you discount is at cost of capital called project NPV or project IRR. Project NPV or project IRR. FCF is discounted at cost of equity called as equity NPV or equity IRR. Equity IRR or NPV can be better than project NPV or IRR if you are paying a lower interest. For example, project is earning 20%. And what you did is you're paying interest of 8%. You're paying interest of 8%. If project earns 20, you should pay 20 to all the three. 20 to all the three. Obviously, you will not pay 20 to the dead guys because they're taking lesser risk. So if you pay less to the dead guy, that extra 12 of theirs will go to equity. That extra 12 of theirs will go to equity. It will not exactly become 20 plus 12, but whatever you did not pay them, who's the residual beneficiary? Equity guy. And unfortunately, if project is generating 6, and debt you have to pay 8, whatever extra pays goes from the equity. Let's do this. This is a very good example. Compute FCFF and FCFE from the following information. FCFF and FCFE from the following information. I will start with FCFF calculation. Let's do FCFF is equal to my starting is 3 lakh PBIT. My starting is 3 lakh PBIT. No interest subtraction. No interest subtraction. So if you ignore interest, tax is 1 lakh 20. 40%. Tax is 1 lakh 20. deduct capital expenditure in a normal manner, deduct working capital increase. Loan repaid will not come in the calculation. Loan repaid will not come in the calculation. New loans taken will not come in the calculation. Equity dividends paid will not come in the calculation. So none of them is going to come in our calculation. So in FCFF, I'm ticking what I'm ignoring: interest, loan repaid, new loans taken, dividends paid. All these are ignored in FCFF calculation. What is the FCFF number? How much? 1 lakh? From FCFF, if you want, you can move to FCFE, or you do calculation from the beginning also. Let me see from FCFF, how do I move to FCFE? How much is the interest paid?
Sir, we will add depreciation also, no?
Oh, sorry. Add back depreciation. Sorry, add back depreciation. 1 lakh is the depreciation. 2 lakh 5,000. Add back depreciation. Sorry. Okay. Now FCFE is start with 2 lakh 5,000. What is the interest net of tax paid? Because you're not paying 50,000. Interest net of tax is how much? This is my first subtraction. This is my first subtraction. Then what is happening? Subtract loan repaid. Subtract loan repaid. Then new loans taken is inflow. New loan taken is inflow. New loan taken is inflow. Some students have a doubt why new loan taken is inflow. Simple. When loan repaid is outflow, new loan taken has to be inflow only. New loan taken has to be inflow only. FCFE can increase if you are taking extra loans. You are taking extra loans. 2 lakh 5,000. From 2 lakh 5, subtract 30, subtract 50 and add back 25. You get how much? 1 lakh. This is the lengthier calculation. This is a lengthier calculation. That was a shorter calculation. A lengthier calculation is presented here. That was a shorter calculation. Any doubts on this? Can you proceed? Okay. Next comes APV approach, adjusted present value approach. What adjusted present value approach says is, these are all, now we move to the final part of it. Utility was not very critical for me. AP onwards, everything becomes a little critical. Now what APV approach says is, you have a project. When you analyze the project, first analyze the project on a standalone basis without knowing what is the debt equity mix. Without knowing what is the debt equity mix. So every project discount at unlevered cost of equity. Discount at unlevered cost of equity. What is unlevered cost of equity? Is using the unlevered beta. Using the unlevered beta, technically the project beta. Technically the project beta. Levered beta is called equity beta. Levered beta is called equity beta. You did the analysis. You got NPV as negative 25,000. You got NPV as negative 25,000. Then they are saying, now I bring in benefits of debt onto the project. Benefits of debt onto the project. See, on a standalone basis, the project is not good. The project is not good. But if you borrow money because of tax benefit, maybe the project becomes better. Maybe the project becomes better. I'm not saying it will become better, but maybe the project becomes better. So they are saying, first you do base case NPV. Is calculated by discounting cash flow at unlevered cost of equity. At unlevered cost of equity. Then PV of debt financing benefit. Debt financing benefit can be in two ways. Okay, there are two things in question. One is the tax saving. Second, one problem what happened is, I was putting up a project in a backward area. In a backward area, let's assume I'm putting a project in a foreign country. In a foreign country, normally the rate of interest on a loan is 8% for me. But that country is saying we'll give you at 6%. So I save interest of 2%. I save interest of 2%. One is tax saving. Second, the normal interest itself can get saved. The normal interest itself can get saved. Both will have to be factored in debt financing benefit. Both will have to be factored in debt financing benefit. PV of debt financing benefit comprise of tax saving plus lower interest rate due to some subsidy. This needs to be discounted at what? In case of perpetual debt, we did this in the valuation of distressed company. In case of perpetual debt, the tax benefit is equal to amount of debt into tax rate. PV of issue cost. What is PV of issue cost is, first you did a base case NPV, you subtracted, you added the debt financing benefit. If I have to do a project, for doing the project, I need to raise debt and equity. For raising that, you may have to incur some underwriting costs, flotation costs, some commission, all that. So that please subtract in your NPV calculation. Now in that, there can be an assumption needed that the issue cost is there. No, you may incur only on debt, or you may incur both on debt and equity. That depends on your assumption. A company is taking a loan at the rate of 4%. Their normal interest rate is how much? 7%. So 3% saving. 3% saving. Normal interest rate is 7%, but I took a loan at what? 4%. So I have a saving of how much? 3%. Loan is for a period of 5 years. So every year I'll be saving 3%. Loan amount is 10 lakh and repaid at one stretch after. This is a very important information. Otherwise, every year you have to calculate the loan amount. Every year you'll have to calculate what is the interest saving, what is the tax saving, and then do discounting. One stretch means every year same amount. So every year I am going to save 10 lakh into 4% into 30%. 10 lakh into 4% into 30%. What is 30%? Is the income tax. Apart from that, 10 lakh into 3%. What is 10 lakh into 3% is, you are going to save 3% lesser tax. You're going to pay 3% lesser tax. So wherever you're doing NPV analysis, you will add 170 to 200. We'll see this in a problem in 2-3 minutes. You will save 1,70,000 to 200. Able to understand this? Next comes the EAB or EAC approach. Now what is this EAB or EAC approaches? I'm analyzing two projects with unequal life. That is, project 1 has a life of 10 years. Project B has a life of 5 years. You are deciding which is a better project. Because you wanted to buy machine A or machine B. We will see two types of problems. One where only outflows are given, no data on inflow. Second type of problem where only inflows are given, or inflows and outflows both are given. If only outflows are there, and if you calculate NPV, it will be negative, obviously. So if only outflows are there in a project, we calculate something called as PV of outflow. We calculate something called as present value of outflow. And if both are there, we calculate something called as NPV. We need to divide this PV of outflow or NPV by annuity factor. And not number of years. Divide by annuity factor. That is, you earn 2 lakh in 2 years. Does not mean you earn 1 lakh per year. Because 2 lakh in 2 years, considering the time value of money, the number will change. Considering the time. For example, I tell you, give me 2 lakh today. I'll repay 1 lakh every year. You will not accept. You will say you have to give me something extra. That something extra is time value of money. Can you tell me 2 years 10% annuity factor? 2 years 10% annuity factor. 1 point. Okay. Assume I take 2 lakh from you. 2 lakh divided by 1.735 is how much? So technically 2 lakh earning NPV is earning equivalent of 1,15,000 every year. Don't tell me it's equivalent of earning 1 lakh every year. That's not the right approach. It's equivalent of earning 115 every year. So divided by what? Present value annuity factor R comma life. Present value annuity factor R comma life for EAC as well as EAB. In EAB we use NPV. In EAC we use PV of outflow. You want to use NPV also, use it, but it will be having negative number. So negative number indicates it's PV of outflow. That's all. Negative number indicates it is PV of outflow. Obviously, I will select a project with higher EAB, lower EAC. Select a project with higher equated annual benefit, lower equated annual cost. Example. company is selecting two mutually exclusive projects. Both projects can be repeated indefinitely. What is repeated indefinitely? Is EAB or EAC assumes this. If you are going to earn 20,000 in 3 years and this is 25,000 in 5 years. So what I can do is I will start with project A, do it once, 3 years over, do it again another 3 years, do it again another 3 years, do it again, do it again. So as you keep repeating, let's assume 15 years got over. Let's assume 15 years got over. Ignore the time value of money for the time being. Let's assume 15 years got over. Project A would have repeated 5 times in 15 years. Would have repeated 5 times in 15 years and earned 5 into 20,000. Earned 5 into 20,000. Project B, you would have repeated only 3 times in 15 years. You would have repeated only 3 times in 15 years and would have earned 25,000 into 3. So that is why just the absolute amount is of no use. Some question says you cannot repeat it itself. You cannot repeat it. Then NPV is what makes sense. Then NPV is what makes sense. See, if I'm going to do project A, I earn 20,000 and I cannot repeat it. Let me earn 25,000. Let me earn 25,000. Why should I earn 20,000? Why should I earn 20,000? Let me earn more. Let me earn more. EAB and EAC inherently assumes that you will keep repeating it. You will keep repeating it multiple times. You will keep repeating it multiple times. Tell me the 3-year and 5-year annuity factor. 12% 3 years, 12% 5 years. 2.402. 3 decimal we normally take. And you need to divide. You need to divide. You will get 8326. You will get 6935. I will go ahead with selection of project A. I'll go ahead with selection of project A because project A has better EAB. Project A has better EAB. Earning 20,000 in 3 years is better than earning 25,000 in 5 years. It's not direct divide by 3 divide by 5. You need to consider time value of money. You need to consider time value of money. Next is abandonment decision. Now, what is abandonment decision? Is deciding whether to give up an existing asset. Deciding whether to give up an existing asset. A lot of people think when to buy a new asset. Should I replace a new asset? But one important decision is when should you give up an existing asset? Just to give an example, you could be using a two-wheeler. Now, on the two-wheeler, as you start using it, after maybe 4 years, 5 years, 6 years down the line, every year, your annual servicing expense keep going up. Annual servicing expense keep going up. So you need to put a stop at some stage saying that I need to abandon this now and buy a new one. I need to abandon this and buy a new one. So for abandonment decision, one, it can be done along with replacement. That's a separate analysis. Only abandonment if you have to analyze. Step 1, initial outflow. What is initial outflow? Is net salvage value of the two-wheeler today. Net salvage value of the two-wheeler today. What is net salvage value? If you sell the two-wheeler today, you would have got 40,000. But if you use it and sell it later, you will get more. You will obviously get less, but there's a time period. So abandonment is deciding whether to sell the car today or use it for another 2 years and then sell it. That's a decision you're trying to take. That's a decision you're trying to take. If you sell the car today, you earn NSV and your working capital also gets released. Your working capital also gets released. Now abandonment says, let's analyze when I do cash flow. I assume that I'm continuing. I assume that I am continuing. If I continue, both of these are my opportunity cost. Both of these are my opportunity cost. I lose the benefit of selling the car for 2 lakh and I also lose the working capital. I also lose the working capital. What will you get? You will get your in-between flow, revenue, expenses, PBDT, depreciation, PBT, tax, PAT, add back depreciation, CFAT, all that you will get. And after few years, you will sell the car. After few years, you will sell the car. That time you will get again an NSV. Again you will get an NSV. You calculate the NPV of this. NPV positive, continue with the car. NPV negative, sell the car immediately. NPV negative, sell the car immediately. NPV positive, continue with the car. NPV negative, sell the car immediately. Clear? Any doubts on this? Let's take an example. A company is re-evaluating the decision to continue with an existing machine. The decision to continue with an existing machine. The machine was purchased for 20 lakh 3 years ago, depreciated based on economic life of 8 years, SLM method. Machine can be sold today for 10 lakh. Tax rate on business profit, capital gain. How much is the opportunity outflow related to old machine today? I want you to calculate NSV of the machine on day 0. What is NSV? Sale value of the machine. Compare with book value of the machine. Capital gain or capital loss. Tax paid or tax saved. NSV. If you sell the machine today, what is the sale value? Can you tell me what will be the book value of this machine? You purchase for how much? 20 lakh. What was the life? Every year 2 lakh 50 you are knocking off. Every year 2 lakh 50 you were knocking off. How many years got over? 3 years. So your left book value is 12 lakh. This is going to lead to loss. On this loss, you have to save tax at capital gain. Tax or capital gain or capital loss, whatever. The income tax on this is only 20%. Business profit 25. Capital gain 20%. So tax saved is how much? And my NSV today is 10 lakh 50. Now what does 10 lakh 50 mean is, if you decide to continue with the machine, this is an initial outflow in the calculation. This is an initial outflow in the calculation. Why did you decide to continue? I'm not getting into it. Whatever be your logic, if you decide to continue with the machine, this is an opportunity cost on day 0. An opportunity cost on day 0. 10 lakh 50,000 is your initial outflow. Now comes the most important discussion. On this, I have a lot of problems to do. Replacement decision. What is replacement? Is selling an existing asset and buying a new asset. So unfortunately, you have to do old machine analysis, new machine analysis, and do an incremental analysis. Old separately, new separately, incremental. Even in a normal problem, also you do incremental, but there will not be two machines data given. For example, I told that if I do this batch, what is the extra benefit? So in your mind, you're doing old, new, but there's no old separate analysis and new separate analysis. But in a replacement, there'll be data for old machine, there'll be data for new machine, and you have to say what is extra depreciation, what is extra revenue, what is extra cost. So keep doing this extra calculation. For doing that, there are multiple approaches to do. So first is, under replacement, we are deciding whether to replace an existing asset with a new asset. Cash flow for a replacement decision will be done by comparing existing machine with the new machine. Our calculation is new minus old. New minus old. Example, capital expenditure of new machine is 1 lakh. NSV of existing machine today is 20,000. So on the new machine, your outflow is 1 lakh. On the old machine, opportunity outflow is 20,000. Extra is 80,000. This is one way of understanding. The easier way of understanding, which I don't want you to know, the easier way is, you will buy the new machine for 1 lakh, sell the old machine for 20,000. Your outflow is 80,000. Your outflow is 80,000. But understand the logic is new minus old. New minus old. Old machine will give you 5 lakh. New machine will give you 8 lakh. Extra 3 lakh. Extra 3 lakh. Old machine terminal value something, new machine terminal value something, again do new minus old, again do new minus old, and finally you will get NPV of the, you will have to keep doing new minus old, new minus old, new minus old at every step. Can you please do this and tell me? Analyze new separately, old separately. Please analyze new separately, old separately. Analyze new machine separately, old machine separately. Don't link them together. And when I say new machine, capital expenditure can also be there, working capital can also be there. What is the capital expenditure of the new machine? 10,000. Okay. Working capital, how is it 4,000? Inventory increase is outflow. Accounts payable increases, inflow, because it's a current liability. It's a current liability. So working capital is 2000. Old machine NSV calculation, sale value is 6000, book value is 2000, capital gain is 4000, tax paid is 1000, NSV is 5000. This is 12,000 outflow. This is 5,000 opportunity outflow. 12,000 outflow and 5,000 opportunity outflow. Net difference is 7,000. Net difference is 7,000. New minus old. There's a lot of calculation presented there, but keep in mind new minus old. New minus old. Okay. Any doubts? Before I start doing questions, let me quickly do 21. Then I take a small break and then I start doing the question. Let's come to this 21. There are 3-4 types of replacement decision questions we are going to do. 3-4 types of replacement decision. First is whether I should replace an existing machine with a new one. For which what you need to do is old separate analysis, new separate analysis, and do new minus old in every step. Do new minus old in every step and get the incremental cash flow. Calculate incremental NPV, positive, negative, positive, negative. Second is I'm yet to buy a machine. I'm yet to buy a machine, and question says what is the optimal life of the machine. You're yet to even buy the machine, and question says what is the optimal life of the machine. So what you need to do is if you buy the machine and use for 1 year, what is the NPV or PV of outflow, and do EAB. Do EAB or EAC. That is use machine for 1 year, 2 year, 3 year, 4 year, 5 year, whatever is the number of years. The life is 4 years, let's assume. If the life is 4 years, calculate what is the EAB if you use it for 1 year. What is the EAB if you use it for 2 year? What is the EAB if you use it for 3 year? What is the EAB if you use it for 4 year, or EAC? Or EAC, whichever has the highest EAB or whichever has the lowest EAC is the optimum life of a car. Let's assume a car has a life of 10 years, but that does not mean you need to use it for 10 years. Maybe the optimal life is 6 years. The optimal life is 6 years. Assume a potential asset of 4 years. Compute NPV, example is 4 years, okay? RPV of outflow for 4 alternatives: 1 year life, 2 year life, 3 year life, 4 year life, and then do EAB or EAC and decide which is the best. Decide which is the best. Your ICS study material has 3-4 questions on this area. Has 3-4 questions on this area, deciding what is the optimal life. What is the optimal life? Then what's the third category? You have already decided that you want to replace a machine. You have already decided that you have to replace a machine. So approach one will not work, saying whether I want to calculate NPV, when to replace and all. Here I want to know when should I replace. When should I replace? So then what I do, let's assume a life is 2 years. Balance life is 2 years. Let's assume a scenario, balance life is 2 years. My first calculation is if I replace immediately, what is the NPV or PV of outflow? If I replace at the end of year 1, what is the NPV or PV of outflow? If I replace it at the end of second year, what is the NPV or PV of outflow? And then finally, if you want, you can take EAB or EAC help. ICI at one place did not do it. I'll explain as we proceed. And then ultimately decide. So 3 type of question. 1, I have an existing machine. I want one answer from you. Should I replace or not? Second, I'm planning to buy a car. Tell me, should I use it for 1 year, 2 year, 3 year, or 4 year? Third, I have an existing car. I want to buy a new car. Don't tell me whether to buy or not. I have decided I want to buy. You tell me, should I buy now, wait for 1 year, or wait for 2 years? That is the answer I'm expecting from you. So 3 types of question. First question is, I have an existing car. Should I replace it or not? Please give me an answer to that. That is type 1. Second, I'm planning to buy a car. Tell me, should I use it for 1 year, 2 year, 3 year, or 4 year? Third, I have already decided that I'll replace the car. Don't tell me whether to replace or not. I know I have to replace. You just tell me when should I replace. Clear? Any doubts on this? Let's. Okay. Next comes the inflation in capital budgeting. I'll quickly discuss. Not sure whether we do a problem now or after break, but let me discuss inflation. Now, whenever I am buying any machine, I use that for a period of 10 years or I use it for a period of 5 years. Revenues today can be 1 lakh. Every year revenue will keep going up. One, because I increase price. Second, because of inflation. Because of inflation. So my cash flows can be with inflation. Cash flows can be without inflation. If you have it with inflation, it is called nominal cash flow, normal cash flow, money cash flow. Normal in a practical world, whatever cash flow happens, because Bharadwaj Institute would have been increasing fees every year. That does not mean we are earning anything extra. That's because of the inflation. That's because of the inflation. So in your balance sheet or in your financial accounts, you write nominal cash flow. You write only nominal cash flow. If you remove the inflation, it's called real cash flow. It's called real cash flow. Similarly, if you consider the discount rate with inflation, it's called nominal discount rate or money discount rate, and without it is called real discount rate. Now, just an example, this will give you good understanding. Today's sales 1000 into 50, 50,000. Next year sales 1200 into 55, 66,000. 50 becoming 55 is inflation. 50 becoming 55 is inflation, which is 10%. Which is 10%. 1000 becoming 1200 is real increase. Is real increase, which is 20%. How much is the turnover increase? 50 becoming 66,000 is what increase? 32%. It is an increase of 32%. Loosely, when I discuss, I can say inflation plus real increase is equal to nominal increase. Inflation, this is a loose discussion saying inflation 10%, volume went up by 20%, turnover will go up by 30%. But in reality, it doesn't happen that way, because two percentages can never be added. Two percentages can never be added. In this example, inflation is 10%. Inflation is 10% and sales increases 20%, but put together is not 30. Put together is not 30. Put together is what? 32%. So we have a formula called 1 plus real increase 20%, 1 plus inflation increase is equal to 1 plus the normal increase. 1 plus 20% into 1 plus 10% is equal to 1 plus 32%, is equal to 1 plus 32. You cannot do 20 plus 10. Why did 20 plus 10 become 32? Reason is simple. 10 is right, 20 is also right, but this 10 increase is also applicable on that 20. 10 increase is also applicable on that 20. 10 into 20 is another 2%. 10 into 20 is another 2%. That's how that 32% happens. That's how that 32% happens. So what you should always do is, whenever we do calculation, I will need one money cash flow or real cash flow. I'll need money discount rate or real discount rate. Concept says only one thing. If you are using money cash flow, use money discount rate. If you have real cash flow, use real discount rate. How do I convert? Using this formula. 1 plus money discount rate is equal to 1 plus real discount rate into 1 plus inflation. Loose formula is MDR, money discount rate, is equal to RDR plus inflation. That's a normal. When I discuss with you, I'll say MDR is equal to RDR plus inflation. Inflation plus the real rate is equal to money. Just add 1 on top of it. Just add 1 on top of it. Can you give me the answer to this? No, that is discussion. That's not the real formula. Give me the real answer. Real answer is 1 plus. Real answer is 1 plus. 1 plus MDR is equal to 1 plus IR plus 1 plus real discount rate. 14.4%. Again, I'm repeating. Loose discussion when I'm doing with you, I can say MDR is equal to this. For example, I had this experience in my interview when somebody asked me a related question of this. So if I'm asking someone in an interview, if you give me 10 and 4, I'll say 10 plus 4, 14. That is like an approximate answer. That's just like an approximate answer. Exact rate you want, 1 plus MDR is equal to 1 plus RDR into 1 plus inflation. How do I move? Then I can move my cash flow from normal cash flow to real cash flow to nominal cash flow. All that we'll see as we proceed. I will explain the calculation part of it with the problem. I'll take a break. We'll resume around 3 o'clock. Around 3 o'clock, we'll resume. Okay, let's now continue with the discussion. I started with inflation and capital budgeting. Let me quickly again do that. What is inflation and capital budgeting? Is the cash flows which are given can include inflation, can exclude inflation. So the approach is very simple. I have real cash flow If you add inflation, it will become money cash flow. It will become money cash flow. And if you discount this, it will come discounted cash flow. There is a DCF, there is an RCF, and there is a MCF. DCF is discounted cash flow, which is the present value. Real cash flow is excluding inflation. Nominal cash flow is normal cash flow, which you see. This cash flow, if you discount at MDR, money discount rate, you will get the discounted cash flow. Money cash flow discounted at money discount rate will give you the discounted cash flow. Real cash flow discounted at real discount rate, discounted at RDR will give you the discounted cash flow, will give you the discounted cash flow. Somebody wants to move from MCF to RCF or RCF to MCF, you just need to add inflation or remove inflation. Add inflation or remove inflation. When I say add inflation, addition can be done. Removal is not minus, removal is division, because when you want to do any discounting, we don't do minus 10%, we do divided by 1 plus 10%. The present value factor is calculated as 1 divided by 1 plus 10%. For example, my real cash flow is 5,000. 10% is the inflation. Nominal cash flow is 5,000 plus 10%, 5,500. From 5,500, if you want to go to 5,000, divide by 1 plus the inflation. Divide by 1 plus the inflation. You cannot just that I want to do minus 10%. That will add inflation will work. Technically, I'm not adding also. Technically, I'm doing into 1 plus the inflation rate. Adding is technically into 1 plus the inflation rate. And when you want to go back, divided by 1 plus the inflation rate. One example around this, real revenue of year 2 is 10 lakh. Real revenue of year 2 is 10 lakh. Inflation of year 1 is 10%. Year 2 is 8%. What is the nominal revenue? What is the nominal revenue? So this is a year 2 calculation. For year 2 calculation, you have to give effect to first year inflation, then to second year inflation. Normally, you will have the same inflation. If you have the same inflation, you could have added into 1.1 power 2. But here the inflation is different. So what you need to do is 10 lakh doing calculator into 1.1. This is giving effect of first year inflation into 1.08. This is giving effect to the second year inflation, giving effect to the second year inflation. So you will have to give effect to not only first year inflation, also to the second year inflation. To cut it short, I have DCF, RCF, NCF. DCF to RCF, RDR, this inflation rate, and this is money discount rate. Money discount rate. From money cash flow, you want to come to discounted cash flow, do MDR. Now, how will this help us in when we do a question? Whenever we do a problem, we have to look for what is the cash flow given and what is the discount rate given. There are few questions where both are directly given. Then if both are directly given, if both are matching, that is both are real cash flow, discount, close it. Both are nominal cash flow, discount, close it. One is real, other one is nominal. You'll have to use the formula, do the conversion and then proceed. Converting the discount rate is easy. Converting the cash flow is difficult. But discount rate conversion can be done only when you have one inflation rate. Few question will say first year this inflation, second year this inflation, third year this inflation, fourth year. In that case, you cannot convert the discount rate. You will have to only convert the cash flow. You will have to only convert the cash flow. Converting the discount rate is only possible if you give me one discount rate, one inflation rate, and then you tell me MDR. 1 plus MDR is equal to 1 plus RDR into 1 plus inflation rate. Like that you can do. Okay, next part 7 of the chapter, which is on expected value, standard deviation, and coefficient of variation. Something which is done for few students at CA inter level. For most of you, you would not have seen this, but very simple. Expected value is nothing but return, probability, product, deviation, PD square. Return is NPV. Return is NPV. NPV, probability, product, deviation, PD square. Sum of the product is called expected NPV. Sum of the product is called expected NPV. Square root of PD square is called standard deviation. Square root of PD square is called standard deviation. And coefficient of variation is risk per unit of return. That's the formula. Risk per unit of return. So risk is the numerator, standard deviation. Denominator is return, which is NPV. Denominator is the return, which is NPV. Expected value, NPV, is the weighted average of various possible value with probability being the assigned weight. Standard deviation is the expected deviation upward or downward from the expected value. Coefficient of variation is risk per unit of return. Format, NPV, probability, product, deviation, PD square. Few questions, instead of doing NPV, probability, product, we'll do cash flow, probability, product, deviation, PD square. When you do cash flow, you will get every year expected cash flow. Every year expected cash flow and every year standard deviation. Every year there are two types of question. One question where you have NPV is available. NPV, probability, product, deviation, PD square. This gives you expected NPV directly and standard deviation directly. Some question we will do cash flow, probability, product, deviation, PD square. When to do those things, I'll explain as we proceed. So that will give you expected cash flow and standard deviation of every year. What is the final NPV? NPV of the expected cash flows. That is year cash flow PV of DCF, year 0 outflow, year 1 expected cash flow, year 2 expected cash flow. Do an NPV of that. And standard deviation is the sum of year 1 standard deviation, year 2 standard deviation, year 3 standard deviation with discounting. Discounting being applied, you'll understand as we proceed. A project is likely to generate cash flow of 1 lakh, 20% probability, 50,000, 40% probability, and minus 25,000. Minus 25,000, 40% probability. How much is the standard deviation? Now listen. For doing standard deviation, this is asking for cash flow standard deviation. It can ask NPV standard deviation also. Our format is cash flow, probability, product, deviation, PD square. Don't write number as 1 lakh. If you write number as 1 lakh, deviation will be 10,000. Okay, 10,000 into 10,000 will run into so many zeros. 10,000 into 10,000 will run into so many zeros. So if they give 1 lakh, I'll do either in hundreds or thousands. So thousands or lakhs. So I'll write it as 100. I'll write the numbers as 100. If you write 1 lakh, no, this would have been 70,000. 70,000 into 70,000. Imagine the number 70,000 into 70,000. You will get stuck at that stage. You will get stuck at that stage. So we'll prefer to do the problem rather than writing the numbers. We'll either do it in thousands or lakhs or crores, because 70,000 into 70,000 into 0.2, you will get stuck. You can write it, but somewhere when you put a total, somewhere you'll end up making a mistake. Clear? Any doubts till this? I'll directly do a question on the problem. When I do a problem, we'll do a directly problem. Project A generates NPV of 10 lakh, standard deviation of 5 lakh. B has NPV of 14 lakh, standard deviation of 8 lakh. Which is better if coefficient of variation is used as a measure of risk? Now listen. One is NPV, which is liked by aggressive investor. Aggressive investor want return. Second is standard deviation, which is liked by conservative investor because you have risk return. So aggressive guy says, give me maximum NPV. Give me maximum NPV 14 lakh. 14 lakh. Conservative guys say, give me lower standard deviation. Give me lower standard deviation. When you club them together, that is called coefficient of variation. The formula is risk per unit of return. Risk per unit of return. So lower CV is better or higher CV is better? Risk per unit of return is the formula. So you want to take lower risk per unit of return or higher risk per unit of return? Lower. So project A 5 lakh by 10 lakh 0.5. Project B 8 lakh by 14 lakh would be some 0.57. So I will prefer project A. I'll prefer project A. We'll do problems on this. Then you do standard deviation. No? There are two types of cash flow. One is called dependent cash flow. Second is called independent cash flow. Now first let me explain what is dependent cash flow, what is independent cash flow. In my regular class video, I've discussed a detailed approach to do the calculation. I cannot do the detailed approach, but I'll explain some logic. Dependent cash flow means I'm starting a project. Project will run for 5 years. Okay. So let's assume Bharadwaj Institute is launching some new product, which is going to be there for 5 years. First year, we did not get good response from students. If first year is a failure, second year failure, third year failure, fourth year failure, fifth year failure is called dependent. That is, if you start with a bad year, you will continue to get a bad year. And if you start with a good year, you will continue to get a good year. You will continue to get a good year. That is called dependent cash flow. That is called dependent cash flow. Most of the cash flow in practical world is dependent. For example, I'm opening a restaurant in the street. If first year there is a good response, high probability, unless I goof up in service and all, I will continue to do well. I'll continue to do well. And if first year I'm failing, high probability I'll continue to fail in future. Independent means first year super performance, second year bad performance, third year moderate performance, fourth year good. Independent means there is no linkage. First year bad, second year can be good, third year can be bad, fourth year can be good, fifth year can be good, sixth year can be bad. There is no linkage at all. That is called independent. Statistically, independent cash flow will have lower risk. Independent cash flow will have lower risk. Reason for that is if you get a bad year, at least some hope is there that you may get a good year. Or if you get a good year, it can turn into bad year. That is, dependent means extreme good performance or extreme bad performance. You will either get an extreme good performance or you will get a extreme bad performance. That is dependent. When extreme happens, standard deviation will magnify. Standard deviation will magnify. When you have independent cash flow, good, bad. So on an average, I may put up a decent performance. On an average if I look at. So we have two types. Dependent cash flow carry inherent risk as a downturn in 1 year tend to lead to a series of consecutive adverse year. And vice versa. In contrast, independent is characterized by lower inherent risk. A subsequent cash flow are not contingent upon the performance of the preceding year. For example, you are going to write your AFM test. Let's assume 10 tests you are writing, full syllabus test. Mostly what you perform in the first exam will have effect on the second, third, fourth, fifth, because your understanding, your knowledge which is there in the first exam is known. More or less, if you are performing well, high probability I expect you to continue to perform well. But your performance in AFM cannot impact your performance in direct tax. That is independent scenario. That is two independent scenario. Whereas the same subject, if I look, it's a dependent scenario. Now, what we do in these type of question is, we cannot follow the earlier approach. If the question says dependent and independent, what is earlier approach is this. Calculating using this approach, NPV, probability, product deviation and PD square. That approach will not work if the question says dependent and independent. In these type of question, you need to calculate every year cash flow, every year standard deviation, every year cash flow and every year standard deviation. So year standard deviation, PVF, discounted standard deviation. Year standard deviation, PVF, discounted standard deviation. Total of DSD, total of discounted standard deviation is one standard deviation. And in another approach, what you do is you square it. You square the standard deviation, put a total and then take a square root. Put a total and then take a square root. This will give a different answer. For example, 8 plus 8, 16. 8 square is 64. 64. What is the square root of 128? So 8 plus 8 is 16. 16 is one standard deviation. 8 square plus 8 square, 128. Square root 11 is another standard deviation depending on the type of cash flow. I said there are two types of cash flow. One is a dependent cash flow. Second is a independent cash flow. Which has more risk? So this is the answer for dependent, more risk. Square root of this is the answer for independent. Which carries what? Lesser risk. Now in class I had shown an example where in year 1 3 cash flows were there, year 2 3 cash flows were there, year 3 3 cash flows there. Independent means any combination can happen. So in class I calculated 27 different NPV. That is first year good, second year bad, third year moderate. First year good, second year good, third year good. First year good, second year bad, third year bad. So any combination can happen in an independent. When I calculated the standard deviation of the 27 different NPV, I got this answer of square root of 128. So basic thing is you cannot do 27 different NPV. If allowed a choice, see, if it's dependent, no, only 3 NPV. Why 3 NPV? All good, 1 NPV. All moderate, second NPV. All bad, third NPV. That is dependent. That is, in this 3, calculate standard deviation, you will get answer 16. In independent, first good, second bad, third worst. Good, worst, bad. So any combination you can do, any combination. So doing so many NPV is not possible for you. That is where the shortcut comes into picture, which is year, standard deviation, PVF, DSD, DSD square, DSD square. Any doubts on this? You'll learn this in a problem. Now some question will say something like this: a project has a life of 2 years. A project has a life of 2 years. Probability of the best cash flow is 30%. Best happening is 30%. What would be the probability of the best case NPV if cash flows are perfectly correlated and independent over time? Correlated and independent over time. I have 2 years, year 1, year 2. If both year best happens, then only I'll get the best NPV. If both year best happens, then only I'll get the best NPV. So this is 30% chance. First year best happening is 30% chance. If it is dependent, second year best happening is 100%. If it is dependent, second year best happening is 100%, because first year best has happened. First year best has happened. Independent means second year again 30% chance. Third year again 30%. Fourth year again 30%. That is when you toss a coin, first time you got heads. Second time will be head only. Third time will be heads only. Fourth time, if you say that, that is dependent. That is dependent. When you toss a coin, it is an independent scenario. It's an independent scenario. So if you need 2 times heads, your probability is 1 by 2 into 1 by 2. Your probability is 1 by 2 into 1 by 2. So for independent cash flow into power n, 30% power 2, 30% power 3 if it's 3 years, 30% power 4 if it's year. So in independent, worst happening or best happening is very rare. Worst happening or best happening is very rare. Whereas the other way around, first year 30%, that's all, that's the probability. No, because you'll do into 100, into 100, into 100. You'll see this in a problem later. Okay, I'll move to the next segment, which is the easiest of the lot, called as RADR and CEF approach. I think among the various items in this chapter, RADR and CEF is the easiest of the lot. Let me first explain what is RADR and CEF. RADR basically, guys, RADR basically says the discount rate which we use cannot be same for all projects. If you have a certain project which is more risky, then you will have to use a higher discount rate, and less risky, you will have to use a lower discount rate. Not sure why this came as a separate approach, because normally our analysis is in this manner only. That is, if you have a risky project, you have a higher discount rate, and if you have a lower risk project, you have a lower discount rate. But RADR makes it very explicit. So a question will give you cost of capital, but you cannot use that as the discount rate for all the projects. You will have to use different discount rate. How can I do this different discount rate? I saw one exam question where they gave standard deviation and they mapped the standard deviation to a discount rate. Higher standard deviation, higher discount rate, lower standard deviation, lower discount rate. In one exam, they mapped with coefficient of variation, saying that something like this. Based on your coefficient of variation, the discount rate will change. If your coefficient of variation is 0.4, you follow 12% discount rate. If it's 1.2, follow 16% discount rate. If it's more than 2, follow 25% discount rate. So this is also one approach we saw. And in one exam scenario, they went ahead and said do RF plus beta into RM minus RF. What is RF is the risk-free rate, but they did not have beta. Beta was called as risk index. Beta was called as risk index, and RM was called as normal cost of capital. RM was called as normal cost of capital. RADR operates on the principle applying a higher discount rate to risky projects, lower discount rate to low risk projects. So if you carry lower risk, the discount rate is determined on the basis by adding the risk-free rate to the risk premium. How can you build the connection? You can build the connection using standard deviation, coefficient of variation, or a risk index. Risk index is like beta. RF plus risk index into normal cost of capital minus the risk-free rate. RF plus beta into RM minus RF. Example, risk index of a project is 2 times. Risk index of a project is 2 times. Normal return I need is 15. So RF 10 plus 2, into 15 minus 10 is the RADR. 10 plus 2 into 15 minus 10 is the RADR. Now once the RADR is calculated, you have your cash flows either given in the question, and if not given, then you have to follow the basics of your capital budgeting and calculate the cash flow and then do NPV. Only rule is NPV cannot be same. When you analyze two projects, normally you use same NPV, same discount rate. You use same discount rate. Here you cannot use same discount rate. One project at 10%, another at 15, another at 20. That is what RADR says. Then came CEF approach, which is slightly difficult for an organization to follow, but it is a better approach than RADR, but difficult to follow. What RADR says is the risk of a project is going to be same across years. When I say across years, year 1 20%, year 2 20%, year 3 20%. CF approach allows us to not change the discount rate. Discount rate under CF approach is equal to risk-free rate. Discount rate under CF approach is equal to risk-free rate. Then what does CF says? I ask the company, what is the cash flow we are going to generate in year 1? Company says 2 lakh rupees. Then ask, how confident are you? He says 90% confident. That 90% is called CF. That 90% is called CF. Moment you tell 90% confident, I don't write 2 lakh. I write only 1 lakh 80 as cash flow. I write only 1 lakh 80 as cash flow. So I reduce the cash flow itself. I reduce the cash flow itself. So I remove the risk from the cash flow. I remove the risk from the cash flow. So then you cannot separately discount it at risky rate. You cannot separately discount it at risky rate. So what you do is 2 lakh into uncertain cash flow into the CF is equal to certain cash flow. Uncertain cash flow into the certainty equivalent factor is certain. Certain means 100% likely to happen. 2 lakh you told, 90% chance, at least 1 lakh 80 will happen. At least 1 lakh 80 will happen. Convert uncertain into certain. Certain cash flow is equal to uncertain cash flow into certainty equivalent factor. The appropriate discount rate is risk-free rate. The appropriate discount rate is risk-free rate. Now, one exam question, they wanted to establish a link between CF and RADR. The link is very simple. They told you do CF, completed everything done. Then they wanted to know if you apply RADR approach. If you apply RADR approach, which one should have higher RADR, which one should have lower RADR. That is no linkage with the NPV which you calculate. Some students thought if you get higher NPV, it means low risk, and lower NPV means high risk. No. I have a project whose certainty equivalent factor is 0.8, 0.7. According to you, which is more risky in this? B is more risky. Lower CF, more risk, more RADR. Lower CF, more risk, more RADR. So which will be discounted at higher RADR? Project B. Project B will be discounted at higher RADR. Certain cash flow is 2 lakh. What is certain cash flow is? With 100% confidence. With 100% confidence. Certainty equivalent factor is 0.8. They are asking what is uncertain. The calculation is uncertain into 0.8 is certain. Uncertain into 0.8 is certain. So if certain is 2 lakh, uncertain is 2 lakh divided by 0.8. 2 lakh. I just tested this in MCQ. Exam question, they'll give you uncertain only. You need to multiply with the CF and make it certain. Make it certain. Now move to the next area, which is called sensitivity analysis and scenario analysis. Scenario analysis is a very simple part of it. You don't have much problem. Sensitivity analysis is a very lengthy kind of a discussion. Practical scenario is more difficult. Sensitivity is easy. Now let me first explain. I calculated the NPV of the project. NPV is dependent on various parameters. It is dependent on cost of the project. If cost of the project increases, I can have trouble. If selling price reduces, I can have trouble. If unit sold reduces, only adverse thing, okay, no positive thing. We are only thinking about adverse changes. We are only thinking about adverse changes. If one change happen at a time, it is called sensitivity analysis. If multiple changes happen at a time, that is called scenario analysis. For example, recalculate the NPV if initial outflow increased by 20%. That is sensitivity analysis. Recalculate the NPV. Practically, I have done both sensitivity and scenario for my clients. Recalculate the profits or NPV if revenue decreased by 5%, variable cost increased by 10%, fixed cost increased by 5%, initial outlay increased by 20%, life of the project goes down by 1 year. Some scenario like this, that is called scenario analysis. Now, scenario analysis is not much in your syllabus, very simple kind of a discussion. In sensitivity analysis, I want to know my project is most sensitive to which factor. What is most sensitive is success or failure of my project is, for example, success or failure of your CA exam is dependent on maybe one subject. That is the most sensitive subject for you. That's the most sensitive subject for you, because if you do well in that subject, you will surely clear. If you do bad in that subject, you may not clear. So something like that for a corporate, if my initial outlay I estimated originally, if it turns out to be the same, I will succeed in the project. Others are not a problem. The initial outflow is the problem. Or selling price is the problem. I decided selling price will be 20. If it turns out to be 20, okay. But if it turns out to be 19 or 18, I will fail. 19 or 18, I will fail. So two ways of measuring sensitivity, or two ways of identifying which is the most sensitive factor. First approach is assume a uniform variation in all the parameter and see how much is the NPV going up or going down. See how much is the NPV going up or going down. So, sir, not going up, going down. NPV will only go down because we are assuming only adverse variation. So, what I did is selling price, cost, variable cost, fixed cost, and initial outflow. I change each of them by 5%. When I change selling price by 5%, my NPV went down by 40%. When I increased variable cost by 5%, my NPV went down by 20%. When I increased fixed cost by 5%, my NPV went down by 80%. And when I changed my initial outlay by 5%, my NPV changed by 10%. This is the most problematic for me. Because if fixed cost changes only by 5%, NPV will change by 80%. So I need to have a lot of control on fixed cost. Before I do the project, I ask the MD is asking CFO, are we sure about fixed cost? Will anything go wrong in fixed cost? If anything goes wrong in fixed cost, our project will fail. Or the CFO would be asking the MD saying that this is the most sensitive factor. I don't want any deviation in this. If a deviation happens, be ready, the project will fail. This is one. Second, MD is asking, you don't tell me the impact on NPV. Tell me how much cushion do I have in each of the factor. What is cushion is selling price can change maximum by 15%. If it changes by 15%, NPV will become zero. If it changes by 15%, NPV will become zero. So I have a cushion of 15% in selling price. Variable cost, I have a cushion of 12%. Fixed cost, I have a cushion of only 5%. In initial outlay, I have a cushion of 20%. Some cushion calculation I'm doing. So if you are following approach 1, you need to find which has maximum fall in NPV. Approach 2, which has the lowest cushion. If you have lowest cushion, that's a problem. Both approaches can be done. Sometimes ICA will say approach 1, sometimes they'll say approach 2. That is, approach 1 is easy to do. That is, change the factor and find the impact on NPV. Approach 2 is you need to find when will it result in zero NPV. Some reverse working you have to do and find. I'll ask at what selling price will we have zero NPV. At what cost price will we have zero NPV? At what initial outlay will we have zero NPV? So you need to answer me at when I'm going to have zero NPV. Two approaches: uniform change in input variable. Consider uniform adverse change in input every variable and compute the impact on NPV. Variable with maximum impact on NPV is the most sensitive factor. Percentage changes, okay, fall in NPV by old NPV. Identify the value of input variable at which NPV will be zero. Parameter with the lowest sensitivity. This is not sensitive, lowest cushion percentage. Parameter with the lowest cushion percentage is the most sensitive factor. Example, we have project cost is 12,000, annual cash flow is 4,500, cost of capital is 14%, life is equal to 4 years, PVIFA is 14%, 2.9137. First, can you tell me the NPV of this project? Quickly tell me the NPV of the project. triple one point. So 13,111.65 minus 12,000. If my initial outflow from 12,000 increased to 13,111, my initial outlay from 12,000 to the project cost, they want the measure of sensitivity for project cost. If project cost from 12,000 increased to 13,111, we will have zero NPV. We will have zero NPV. So project has a cushion of 13,111.65 minus the original project cost 12,000 divided by 12,000. That is, project can absorb 9.27% increase, 9.27% increase in the initial outlay. This is for the project cost. Like this, you can do it for any parameter. Now, next example. Identify the factor which is having maximum sensitivity to the project. Base NPV 200. If you do 10% increase in selling price, if you do 10% increase in or decrease in selling price, NPV becomes how much? Which is a 25% fall. From original 200, it is a 25% fall. Second parameter, it is a 10% fall. Third parameter, it is a 50% fall. Fourth parameter, it is a 20% fall. Which is leading to maximum fall? Variation in life. So life is the most sensitive factor here. Life is the most sensitive factor. Next, a project currently has NPV of 25 lakh. However, the project is sensitive to multiple factors with a significant variation can cause reversal of investment decision. Reversal of investment decision means from positive NPV you will get to negative. Indirectly, this is the cushion available. Selling price, you have 25% cushion. If you have a 25% variation, no problem. More than 25, you will get into negative. Which has the lowest cushion percentage? Fixed cost. So fixed cost is the lowest cushion. Fixed cost is the lower. See, in approach 2, you find the lowest cushion percentage. In approach 1, you find the maximum impact on NPV. Maximum impact on NPV. Clear? Any doubts on this? Good morning, friends. Okay, let's quickly first close the capital budgeting area. I'll quickly cover the balance 3 concepts which are pending, do few questions on that, revise it, and then I move to the next segment. So in capital budgeting, we are still left with decision tree discussion, simulation, and something called as a real option in capital budgeting. Now, decision tree is not something new or different. It is basically used for something called a sequential decision making. What is sequential decision making is, when I evaluate a project, I say year 1 cash flow is 20 lakh. You ask me year 2, I give 10 lakh. Year 3, 5 lakh. I give one number. Now suddenly if you ask me, I say year 1, 20 lakh, or it can be 10 lakh, or it can be 5 lakh. If it happens 20, then it can again be 15 lakh, 10 lakh, 2 lakh. Then again it can be. So if I give you multiple answers or multiple options, you will find it very difficult to do it without a diagram. So the diagram is basically called as a decision tree. The diagram helps you in understanding what is happening in the company or what is happening with the project. Just to give an example, I want to calculate the NPV of a project. So for that, the first thing is to do project, not to do project. If you don't do, the value is 0. If you don't do it, the value is 0. You don't get anything. If you do project, first year can be success, can be failure. First year can be success or failure. If it is success, you can invest 20 lakh, you can invest 10 lakh. If it's failure, you can sell your business for 5 lakh or 3 lakh, something like that. You will keep. If it is 20 lakh, then again it goes further. There are 2 types of notes which will come. When you draw the diagram, there are going to be 2 types of notes which are going to be there. One is called a decision node and second is called a chance node. A decision node is where you will put a rectangle or a square. A decision node is where you will put a rectangle or a square where you have a choice whether to go up or go down. That is, you can go and say I will do the project. You can also say that I will not do the project. You can say I will do the project. You can also say I will not do the project. So wherever there is a decision node, the answer for that, every node has to be valued. Every node has to be valued. The answer for that is the higher of the two, higher of the branches which come from that decision node. Once you do, it's a circle here. What a circle is, success or failure is not in your hand. Success or failure is not in your hand. Once you get success, it is a rectangle, because you can decide whether you want to put 20 or 10. You can decide whether you want to put 20 or 10. If it's a failure, again maybe it is a box where you can decide whether you want to do 5 or 3. Wherever you can decide, it is a box. Wherever you cannot decide, it is a circle. Wherever it is a circle, the branches need to have probability. The branches need to have probability. Without probability, you cannot proceed ahead. Without probability, you cannot proceed ahead. So there are two types of nodes. One is a decision node, second is a chance node. Decision node, for example, you'll value this. This is 10 and this is 0. Higher of the two is the answer for the rectangle. Higher of the two is the 2, 3, 4, 5, 6. It can be anything. It can be anything. Higher of that is the answer for the rectangle node or a decision node. Chance node is a weighted average of success and failure. Weighted average of success and failure. Moment I say weighted average, I need probability. Moment I say weighted average, I need probability. So you need to attach a probability for success. You need to attach a probability for failure. You cannot attach a probability to do the project, not to do the project. That's your hand. You can do the project. You can decide not to do the project. That's purely your choice. Which choice you want to implement, that's up to you. If you do, it's okay. If you don't do, it's okay. So that's a choice you can take and then proceed ahead. So under a decision tree, I try to make this in a diagrammatic form so that it's easier for me to proceed and analyze it. It's easier for me to proceed and analyze. Decision tree is a diagrammatical representation of the various alternative courses of action. This is useful for sequential decision making. What is sequential decision making is, let's assume you have to make 5 decisions. Based on the D1 you take, the D2 can change, the question can change. For example, first is to do the project, not to do the project. Not to do, there is no extra decision. To do the project, the next question to use, if you get success, this is the question. If you get failure, this is the question. After getting success, next year if you get success, this is the next question. Next year you get failure, this is the question. So I can keep asking you questions and you will have to keep deciding them. You will have to keep deciding them. Assume you travel to not to do side, then none of the other decision you need to take, because you have moved to the not to do. So this makes it easier for me to evaluate a complex problem. See, whenever I also do a question, when I have something very difficult to explain, I normally take the route of a diagram to explain, because diagram makes it easier for a person to understand. That is what decision tree is all about. So you will draw the decision tree like this, and valuation you will do it in the reverse order. Valuation you will do it in the reverse order. That is, the last node will be valued first. We'll call them as D1, D2, D3, C1, C2, C3. D1 is called decision node, C1 is called chance node. A decision node, a decision tree begins with a decision node. Decision node D1, D2 is denoted by rectangle, is denoted by rectangle. Chance node is denoted by circle. Chance node is denoted by circle. The value of the chance node is the weighted average. Weighted average of the various branches coming out of the chance node, and decision node is the highest of the branches. You can decide whether you want to go to the top, whether you want to go to the bottom. To do all of this, somewhere joint probability is going to be very critical. Joint probability is going to be very critical. We have analyzed joint probability at few other places also. Joint probability is basically happening of two events together. Happening of two events together. So joint probability of event 1 and event 2 happening together is equal to probability of event 1 into probability of event 2. Probability of getting a cash flow of 50,000 in year 1 is 40%. If the cash flow turns out to be 50,000 in year 1, then probability of getting 24,000 in year 2 is 20%. What is the probability of getting cash flow of 24,000 in year 2? Getting cash flow of 24,000 in year 2. Let's understand this properly. Probability of getting cash flow of 50,000 in year 1 is 40%. If the cash flow turns out to be 50,000 in year 1, then the probability of getting 24,000 in year 2 is 20%. Just give me a minute. Just add a word. What is a joint probability? Joint probability Okay, so if you want 24,000 in year 2 and 50,000 in year 1, you'll have to multiply both the probabilities. You'll have to multiply both the probability. That is 40% is the first year probability, 20% is the second year probability. Put together, you will have a probability of, next comes the next technique, which is called simulation. Now, what a simulation is? Uh, creation of a real-time scenario. Creation of a real-time scenario. For example, a cricket match is going on, so that is being played in the stadium. I want to simulate exactly the same thing in a cricket game. In a game, I am going to play over my TV in using some game software. I'm going to play a game in my laptop. So that is called as a simulation exercise, where I'm trying to create a real-time scenario. Simulation is basically needed where all other techniques are failing, For example, I ask, what is the revenue you will make? You're saying it can be this, it can be this, it can be this, it can be this, it can be this. You're giving some 10 different numbers. Then I ask you, what will be your cost price? Again, you give me 10 different numbers. I ask you, what will be your selling price? Again, 10 different numbers. Ask you, what is the life? Again, 10 numbers. So you give me so many numbers, keep giving this numbers. Now I'm stuck. I don't know what to do. So then I ask, can you attach probability to every number? Can you attach probability to every number without? So for doing simulation, I need two things: range of possible numbers and probability. Range of possible numbers and probability. If you give me that, then I can start doing the simulation. For example, my selling price can be 20, 25, 30, 35, 40. It can be any of this. There is a probability attached to each of this. Probability is 0.1, 0.3, 0.1, 0.1, 0.4, 0.1. I attach probability and I have given this. Then ask you, what is the cost price? Again, you gave 5 numbers. I asked you, what is the life? Again, you gave 5 numbers. What is the initial investment? You gave 5 numbers. So once you give this number, I will put this data in the form of a random number table. I'll put this data in a form of a random number table. What is random number table is? Start 20, 25, 30, 35, 40. These numbers are there. Probability is there. 0.1, 0.3, 0.1, 0.4, 0.4. I'll calculate something called as cumulative probability. The price can be in the ascending order, price can be in the descending order, price can be in the random order also. Doesn't really matter, but ICA normally follows ascending order. Now you need to put random numbers to this. A random number can be a single digit, can be a double digit, can be a triple digit, can be a 4 digit. It can be anything. Let's assume I take double digit. For double digit, I want this to be in 2 decimals. I want this number to be in 2 decimal. Okay. So what is random number is? 0.10, 10, 40, 50, 90 and 100 are the numbers. So random number is equal to 00 to 09. What is 00 to 09 is? 09 is the number before 10. 09 is the number before 10. Then 10 to 39. 39 is the number before 40. 40 to what I should write? Number before 50. 50 to 89. 92. Why number before? Because I stop at 2 digit. Same thing you want to do 3 digits. Add one more decimal. Read this as 100, 400, 500, 900 and 1000. Read this as 100, 400, 500, 900, 1000. What is the number before 100? So 00 to 099, 3 digits. 100, 399. 400 to 500 to 900 to some random numbers we have put some random numbers. Let's take 2 digit. Now I'll be running experiment for 1500 times. I'll run an experiment. So first experiment, I want to know what will be the selling price. I'll do very simple thing. I'll just pick up a random number. Random number is now Excel is picking a random number between 1 to 99. It just picked a random number between 1 to 99. It is like I put the numbers, you pick any number. So 44 came. In the first experiment, selling price will be 30 rupees. Selling price will be 30 rupees between 40 to 49. Between 40 to 49. I want you to run one more experiment. Unfortunately, the formula is such that you change any number, the random number will keep changing here. So second experiment, the random number is 7. 7 is between which one here? 00 to 09. So your selling price will be now 20 rupees. Selling price will be 20 rupees. Like this, you will run thousands of experiment. You will run thousands of experiment on selling price, on cost price, on live. Excel can do any number of experiments. Once you are done with all these experiments, you will get 1000 different NPV. Simple average of that is the final NPV. Simple average of that is the final NPV, because I am not having any bias here. I'm running my experiment for 1 lakh times. I can run even for, practically I have done simulation. I have done simulation to find out certain data points. So you can run this experiment for any number of times. You can run this experiment for any number of times. Like this you do it on selling price, like this you do it on cost price, like this you do it on, there are two things. One is something which is not going to change. For example, my initial investment will only be 20 lakh. Don't run any experiment on that. Don't run any experiment. I will not run. Life will be 10 years. Don't run any experiment on that. I will not run it. But discount rate can change. Your cost price can change. Selling price, anything which changes, I need a random number table. I need a random number table. Now, should I do 2 digit, 3 digit, 4 digit? Again, it's random. There's no logic I can add. Random number is anything you can do. You can do a 2 digit one. You can do a 3 digit one. If the probability is in a single decimal, you can do 1 digit also. If it's in 2 decimal, you should do 2 digit random number. If it's 3 decimal, you should. For example, this I could have done even single digit. What is the number before 1? 0. So 0 to 0. It is 0 to 0. What is the number before 4? Number before 4. 3. 1 to 3. Number before 5. So 4 to 4. Number before 9. 5 to 8. And last one is 9 to 9. And here what I'll do is I'll fix a random number between 1 and 9. I want a random number between 1 and 9. You got 1, price is 20 rupees. You got 7, price is 35 rupees. You got 3, price is 25 rupees. You got 7, price is 35 rupees. You got 8, price is 35 rupees. You got 6, price is 35 rupees. Like this, you can keep running any number of experiment. You can keep running any number of experiment. Practically, we do thousands and thousands of experiment. We do thousands and thousands of experiment on each of the parameter which is going to change. On each of the parameter. ICI arranges the price in ascending or descending. Being random number, any order you put doesn't really matter. Any order you put doesn't really matter. But from problem solving, we will arrange the prices in the ascending order and then do it. Any doubts on first the concept? Concept is you have a situation where you don't know. Now somebody may ask, why don't I do a weighted average of the price, weighted average of it? That is possible. That is doing, ensuring that you get only one NPV. But I want to run experiment for multiple times to check whether what and all can go wrong. After doing so many experiment, I may find how many times I'm getting negative NPV, which may tell me that okay, 20% I may fail also. 20% I may fail also, or 10% I may fail also. Along with doing the simulation, practically we do something called as normal distribution analysis. Whatever NPV is calculated, that is put in a normal distribution graph like this. This is called a normal distribution graph, which will ultimately tell me some probability analysis and helps you, because the objective is to focus on risk. Objective is not to focus on return here. What is focusing on risk? What is the probability of failing? What is the probability of failing? So I'm checking whether I may fail or not. I'm not checking here whether I'm going to pass or not. So the objective is to check. Now simulation says, because you're doing so many experiments and all, you should do your NPV calculation at risk-free rate. You should do your NPV calculation at risk-free rate, because risk is anyway considered in so many experiments, which many authors are not okay with it. Because when you do final NPV and say weighted average or a simple average, you say this is the final NPV. That final NPV unfortunately was calculated at risk-free rate. Unfortunately was calculated at risk-free rate. When I did certainty equivalent factor, I downward revised the cash flow. Cash flow itself was revised downward. Here you don't revise any cash flow and all. Whatever cash flow the experiment gives, the same cash flow you continue. Same cash flow you continue. One of the limitation of simulation is doing this calculation at risk-free NPV. At risk-free rate. In fact, not only simulation, CF approach says you have to do it at risk-free rate. When you do your standard deviation calculation, some question will tell do it at risk free rate, do it at risk free rate, because return is separate analysis, risk is separate analysis. Don't try to combine them, don't try to combine them together. But logically speaking, NPV should always be calculated only at risky rate. CF is an exception, because in CF cash flow is adjusted. CF is an exception. Simulation is an exercise to imitate a real time problem and arrive at expected results for a large number of experiment. Practically thousands and lakhs of experiment can be done. Final result can be taken as simple average of various experiment. Identify parameters. What is parameter? Items that don't change, and variables, items that change. For each variable, arrange the values in ascending order and calculate cumulative probability. Construct a random number class interval at each variable. Based on a random number and a class interval, select the values. Select the values. NPV, appropriate discount rate, RF, simple average. Simple average. Example. Can you do this example and tell me if random number is 70, what will be the cash flow? If random number is 70, do cumulative probability, fit in random number. Do cumulative probability, fit random numbers. Please fit random numbers. Write cumulative probability in the side first. Do cumulative probability and fit random numbers. What is the cumulative probability? 0.25, 0.70. What is the random number for this? 002. Why 00? Because 70 is a 2-digit number. 70 is a 2-digit number. Next one is 70 is which one? Third one, 30,000. 70 is the third one. So our cash flow is going to be 30,000. Okay, option in capital budgeting. So sometimes what can happen is, I want to do a project today. The project is not a good one. It is going to generate negative NPV for me. For example, Reliance, when they wanted to introduce Reliance Jio, they said for the first year, let's spend 500 crore rupees and make loss. Let's spend 500 crore and make loss. I did NPV analysis. First year alone, if I do analysis, and I may get to know that the project is a failure. But at the end of 1 year, I'm going to take one important decision. What the decision is, I may decide to expand, or I may decide to close down. I may decide to expand, or I may decide to close down. If you decide to close down, entire 500 is gone. That's a problem for you. But you may decide to expand also. That is an option given to you. Which you may exercise depending on how the business is doing. If Reliance Jio, when they introduced, if the response was bad, maybe they would have closed it down. But the response was very good, so they expanded their operation. So there can be an option to expand. There can be an option to abandon. Abandon is closing down a business. Option to expand is technically like a call option. Option to abandon is technically like a put option. I'll discuss that part of it when I go to your derivatives. Simple logic here is, sorry, can you please be on mute? Simple logic we are trying to do here is, sorry. Yeah, friends. Okay. So I may decide to expand in future, or I may decide to abandon the project in future. But to do all that, first you need to do the initial investment. It is like you construct a building. The base project is the foundation. Without doing the foundation, you cannot construct the first floor. First floor is an option which you may do, may not do. Foundation on a standalone basis is a bad project. But because of the foundation you created, you are able to do one more project. one more project which is giving you money, what capital budgeting is saying is please evaluate them together. I'll give you an example. ABC is evaluating a new piece of equipment that will automatically install power windows in cars coming off the production line. The equipment will cost 35 lakh, and the firm estimates that the present value of the savings from installing the equipment is 28. That is, I will spend 35 lakh on the equipment and I'll save how much? 28 lakh. So I lose how much? 7 lakh. I'm thinking of whether to install this equipment. I gave this information. You said don't do it. Don't do it because 7 lakh loss is there. 7 lakh loss. Then they're saying production manager is also considering purchasing a module that will allow the equipment to be used for company's SUV production. He is also thinking of purchasing a module that will allow the equipment to be used for company's SUV production. If you want to buy the module, first buy the equipment. Equipment you are saying you don't want to do it. Why are you saying you don't want to do? Because it is having negative NPV. But if you buy this module, the module is a real option. Which will give you how much? Cost of 11 lakh, but will save you how much? 20 lakh. So the module has a NPV of 9 lakh. Our module has a value of 9 lakh. In this example, base NPV is negative 7. Value of the project is 9 lakh. Value of the option is 9 lakh, and overall NPV is 2 lakh. So what is the NPV of the project before? Before is negative 7. After, another 9 lakh added, 2 lakh. In this I can attach probability. What I can attach probability is negative 7 is okay. This real option is there. But there's only a 60% chance that you will buy the module. There's only a 60% chance. If there's only a 60% chance, I can earn only 60% of 9 lakh. Which is 5 lakh 40. My base NPV is higher. I don't want to do both. I don't have a choice of only doing the module. I'll have to do both or reject both. Or I can even do only one. Only one is only foundation. If option is bad, let's assume in the option they say you have to spend 25 lakh and you'll get 20 lakh. I'll say I don't want to do option. Let me do only the foundation and end it. So in material, you have certain examples. These are good problems, not much to solve. There will be a base NPV and then there will be some data on the expansion. Do give it a try at home. You'll understand them better. There's a base option and there's a value of the option to expand. I'm kind of done with the entire capital budgeting part. I will quickly summarize them. The entire capital budgeting part. I have gone this little bit slow than my usual speed. So this is little bit on the slower side. I in fact wanted capital budgeting to get over yesterday itself. It didn't get over. Okay, let's quickly summarize them. First thing is basics of capital budgeting, where we have 6 techniques of capital budgeting: payback, discounted payback, NPV, profitability index, ARR on average investment, ARR on initial investment, and IRR. IRR can have a modified IRR as well. What is payback is? Payback refers to the number of years in which you recover your initial investment without considering time value of money. Year, cash flow, cumulative cash flow. You start with a negative value and you keep writing base year plus unrecovered cash flow of base year divided by cash flow of next year. Discounted payback, same calculation, but you have to consider time value of money. Year, cash flow, PVF, DCF, CDCF. Cumulative DCF, you will have to look. The last year in which cumulative DCF is negative is called base year. Base year plus unrecovered discounted cash flow of base year divided by discounted cash flow of next year. Third technique is NPV, most commonly used one. NPV is present value of inflow minus present value of outflow. Payback, lower the better. Discounted payback, lower the better. NPV positive is better. Profitability index or benefit cost ratio or present value index or desirability factor is the ratio of benefits to cost. Benefits is present value of inflow, cost is present value of outflow. Anything greater than 1 is better. Greater than 1 or greater than 100%. It can be expressed in times, it can be expressed in percentage. If you have NPV in the question and outflow in the question, you can combine them together and get the inflow and calculate the profitability index. Accounting rate of return is the ratio of average profit to the initial investment or average investment. Average profit is equal to sum of all profits divided by the number of years. Initial investment is initial outflow. Average is initial plus salvage value divided by 2. IRR is the rate of return at which NPV of the project is 0. If you are generating positive NPV, IRR is greater than discount rate. If you are generating negative, IRR is less than discount rate. And if you are generating 0, IRR is equal to discount rate. In order to do this, I need one positive NPV and one negative NPV, for which I need a guess rate. Guess rate is technically equal to 2 by 3. 2 by 3 of ARR on average investment. 2 by 3 of ARR on average investment. Moment you get one positive, one negative, L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1R. There's a shortcut approach when you have one inflow, one outflow. Future value is equal to present value into 1 plus R the whole power N. What discount rate do I use for project evaluation? I'll have to use the cost of capital normally. If there is anything specific given to the project, please use specific given to the project. Also, what can happen is there can be revision in cost of capital. There can be a revision in cost of capital. If there is a revision, then PVF of year 2 is equal to PVF of year 1 divided by 1 plus the new discount rate. Rules for computation of cash flow. Depreciation is a non-cash item. Please ignore it, but consider the tax benefit on depreciation. How is it considered? It is auto considered when you deduct depreciation and add back depreciation. When you deduct and add back. Opportunity cost is the cost of the benefit foregone. If you have pre-tax opportunity cost, deduct before PBT. If you have post-tax opportunity cost, deduct after PAT. Deduct after PAT. Sunk cost is something which is already incurred. You can ignore it in your analysis. Overheads, apportion, general, corporate is ignored. Specific or incremental is considered in the calculation. Working capital, increase in working capital is an outflow, decrease in working capital is an inflow. You'll have to ensure that you do this calculation of, we were doing this analysis even when I did corporate valuation. Corporate valuation also we did some adjustments on working capital front. Reward exclusion principle says, whoever you are evaluating, if you are evaluating for FCFF, ignore the reward paid to debt, equity and preference. If you are doing FCFE, ignore the reward paid only to equity shareholders. Incremental principle is consider only the incremental revenue or incremental cost in your analysis when you are evaluating with the original scenario. Simple rule for finding a relevant item is doing yes or no analysis. What is yes or no analysis is, you will check an item and see if you do the project what happens, if you don't do the project what happens. If there is a difference in the answer, it is a relevant cost. If there is no difference in the answer, it is not a relevant cost. Steps in calculation of cash flow. I have initial outflow, which is capital expenditure, working capital. Apart from this, I can have some compensation paid, I can have some installation charges, I can have a subsidy, I can have a government grant. All that can come into my initial outflow. In between flow is equal to incremental revenue, incremental cost saving, all cost other than depreciation, PBDT, deduct depreciation, PBT, deduct tax, BAT, add back depreciation, CFAT, and 3 items. Increase or decrease in working capital. Increase in working capital is outflow, decrease in working capital is inflow. Payment for original machine. If you have not paid fully, now make the payment. Purchase of additional machine and sorry, add back depreciation. Sorry, yeah, only these 2 items will come. Then terminal flow is equal to net salvage value, a recapture of working capital. Net salvage value is comparing sale value with book value, which can lead to capital gain or capital loss. There can be a tax paid or tax saved, and you leave a line and write net salvage value. An organization has 0 sale value, but it can have NSV. It can have NSV because of capital gain or capital loss. And in case sale value and book value same, in case sale value and book value same, NSV is equal to sale value. NSV is equal to, if question says tax on capital gain is ignored, directly you can write it. Consolidate them together. Year 0 will come from step 1, 1, 2, 3, 4 will come from step 2, and last year will come step 2 plus step 3. Mostly will calculate NPV. Mostly will calculate NPV. If you are following block of assets method, no capital gain, capital loss unless the block is fully exhausted or the value is fully exhausted, and depreciation will be charged on opening block value. Add the block value because of addition, deduct because of sale, and on that amount you will charge depreciation. If you buy any asset at the beginning of the year, capital budgeting assumes it will happen only at the end of the year. Any asset at the beginning of the year will have to be written in the previous year. Impact of losses. Losses can save income tax for a company in case you have adequate profits in other businesses. So any loss will lead to immediate tax saving if you have profits, will lead to deferred tax saving in case question says carry forward and set off, and last scenario where you have no carry forward, no set off. Tax exemption. If there's a tax exemption for a specific percentage of profit, my effective tax rate goes down. Effective tax rate is equal to normal tax rate into 1 minus the exemption percentage. Expenses not paid in the year of incurrence. If you don't pay some of the expenses in the year of the incurrence, it will become a current liability and will be reflected as decrease in working capital. Will be reflected as decrease in working capital. Treatment of subsidy or government grant. If you get any subsidy or a government grant, you can split them into capital grant or revenue grant. Capital grant may be adjusted with the cost of the asset, may not be adjusted with the cost of the asset. If it's adjusted with the cost of the asset, lower depreciation. If it's not adjusted with the cost of the asset, no lower depreciation. Revenue grant can be taxable, can be exempt. If it's taxable, right before PBT. If it's exempt, right after your PAT is calculated. Utility value, weighted average of the various possible utility value with probability being the assigned weight. Select a project which has higher utility value. FCFF versus FCFE approach. FCFF approach basically says ignore the reward paid to debt, equity and preference. FCFE says ignore the reward paid only to equity guy. FCFF approach is discounted at KO to get project NPV, project IRR. This is discounted at KE to get project IRR or equity equity NPV and equity IRR. Adjusted present value approach basically says first evaluate the project without bringing the debt equity mix. Assume it's fully equity funded. Calculate base NPV. When you do base NPV, no issue cost, nothing needs to be brought in. Base NPV is present value of future cash flows discounted at unlevered cost of equity. Unlevered cost of equity. Then bring the tax angle. Debt has tax benefit. There are two benefits. One is tax benefit. Second is lower interest. Lower interest. Factor that and deduct something called as issue cost. Deduct something called as issue cost. EAB or EAC approach can come into picture when you are going to repeat something continuously and the life of the two projects are different. EAB is equal to NPV divided by annuity factor. EAC is equal to present value of outflow divided by the annuity factor. Abandonment decision is deciding whether to give up my existing car or not. Technically, there is no outflow, but opportunity cost. What is opportunity cost? NSV of the car today and working capital block today. You do your in-between flow in the normal manner. Terminal flow is NSV of the car again. NSV of the car again at the end of life. Recapture of working capital. NPV positive. Continue with the car. NPV negative. Please sell it. Please sell it. Then comes the replacement, which is combination of new purchase and abandonment. That is, you are going to buy a new asset in place of an existing asset. Buy a new asset in place of an existing asset, which is called replacement decision. Three types of problem. One, pure replacement question where you analyze old separately, new separately, do incremental. When you do old analysis, you have to consider net salvage value in step one. You can do old minus new in a single working note also. You can do it as separate columns also. That's your wish depending on the comfort on your question. If you're doing it in a single column, then you'll say sale value, purchase price of the new machine is outflow, sale value of the old machine is inflow. If you do it separate, new minus old, both will be negative. Minus of minus will become positive in the calculation. Minus of minus will become positive in the calculation. Second is deciding what is the optimum life of a machine. Deciding what is the optimum life of the machine, whether you have already purchased it or you're going to buy it in future. So if you have already purchased it, you're not analyzing for that machine. You're analyzing for some other machine. You're analyzing for some other machine because I'm going to continuously, I'm part of company Ola. I'll be continuously buying cars. So I keep buying cars. Every year I keep buying 100 cars. Now with this 100 cars, what is the right life? 2 years, 3 years, 4 years is what I'm deciding. To do that, you will have to calculate buy, use for 1 year, buy, use for 2 years, buy, use for 3 years, buy, use for 4 years. In this calculation, you can follow NPV approach. You can follow PV of outflow approach. NPV if inflows are given. PV of outflow if only outflows are given. So whatever number you get, if you get NPV, divide by the PVAF, you'll get EAB. R divided by EAC. Third is when should I replace? When should I replace? For doing when should I replace, if I have very limited option, that is today and 1 year, do the cash flow properly. That is, if you replace today, what happens? If you replace a year later, what happens? Life is going to be different. Go with EAB or EAC. But where you have multiple options and life is longer years, then you calculate the EAC of the new machine first. EAC of the new machine first, and then say old machine for 0 year, new machine for 4 years. So you sell old machine for 1 year, new machine for 3 years, old machine for 2 years, new machine for 2 years. So that's an approach we can follow. So three types of question: evaluating the replacement of an existing machine with a new one, determining the optimum life of an asset yet to be purchased or purchased also, purchased also, and when to replace an existing asset. Inflation and capital budgeting, there are two types of cash flow. One is nominal cash flow and second is real cash flow. Nominal cash flow is also called as money cash flow, which includes inflation. Real cash flow excludes inflation. Nominal discount rate includes inflation. Real discount rate excludes inflation. Real cash flow plus the inflation percentage is nominal cash flow. Nominal cash flow divided by 1 plus inflation rate is the real cash flow. So you can move from here to there, from there to here. 1 plus money discount rate is equal to 1 plus real discount rate into 1 plus inflation. I don't remember a formula. Logic is money discount rate is RDR plus inflation. You cannot add percentage, so you add a 1 and then do multiplication. Expected value is the weighted average of the various possible value with probability being the assigned weight. In approach 1, which is used in two situations, NPV directly given, or they ask you best case and worst case. NPV, probability, product, deviation, PD square. Sum of product is the expected NPV, square root of PD square is the standard deviation. In some question, they don't even ask NPV, they give cash flow. Then cash flow, probability, product, deviation, PD square, no multiple years, only 1 year, only 1 year. Then you have something called as coefficient of variation, which is risk per unit of return. Risk is standard deviation, return can be NPV or only cash flow. There are problems where only cash flows are given. Second type of a question, which is what we will do in most of the problem, where cash flows are given with probability. The cash flows can be every year, a cash flow can be only once they would have given, and same will get repeated. First thing is you'll have to calculate the expected cash flow and standard deviation for every year. How you do? Cash flow, probability, product, deviation and PD square. Sum of the product is year 1. If the same gets repeated, same for year 2. Same gets repeated, same for year 3. Same gets repeated, same for year 4. And your standard deviation will also be same. Based on the expected cash flow, you calculate an NPV, that's called expected NPV. That is called expected NPV. And based on the standard deviation, you do year, standard deviation, PVF, discounted standard deviation, DSD square. DSD is the total of NPV, standard deviation if the cash flows are dependent, and square root of DSD square is the standard deviation if cash flows are independent. Independent is less risky, dependent is more risky. Dependent and independent scenario. If you want probability for a dependent NPV, if probability for a dependent cash flow is equal to probability of year 1, independent is probability of year 1 into year 2 into year 3 into year 4 into year 5. So we end up doing power number of years. RADR is basically saying if you have a risky cash flow, discount it at a higher rate. If you have a less risky cash flow, discount it at a lower rate. So RADR is equal to risk-free rate plus risk premium, or you can apply a formula called RF plus risk index into normal rate minus the risk-free rate, or you can calculate based on coefficient of variation or based on standard deviation. Certainty equivalent factor basically says I want to give confidence to the given cash flow, so I'll convert the uncertain cash flow into certain cash flow by multiplying with certainty equivalent factor. So uncertain cash flow is given in the question. Certain cash flow is equal to uncertain cash flow into the CF. Uncertain cash flow into the CF. You'll have to discount this at risk-free rate of return. High CF indicates low risk, low RADR. Low CF indicates high risk, high RADR. That's the link between the two. Sensitivity analysis and scenario analysis. Sensitivity analysis, one change at a time. Scenario analysis, multiple changes at a time. For sensitivity analysis, we have two approaches. One, assume uniform adverse change in each of the variable and find out the impact on NPV. Higher the impact on NPV, more is the sensitivity factor. Second approach is finding out cushion percentage. That is how much cushion is available in my input parameter. How do I calculate the cushion available? I found out at what will be the zero NPV. Change by base into 100. How much should be the change? What is the base into 100? Lower the cushion percentage, more problematic is that factor. Scenario analysis, you consider multiple changes at a time and then do it. Then today we started with decision tree. Decision tree is diagrammatic representation of various decisions to be taken. Start with a decision node, which is a rectangle, can be broken down into two circle, can be even broken down into two. Again, if you take further decision, circle can again become rectangle, rectangle can become circle. Whenever you are putting a rectangle, the two branches will not have probability. Wherever you put a circle, the branches need to have probability. If branches are not having a probability, it means it is not a circle, it is a decision. So value of a decision node is the highest of the value of the branches coming out of it, and value of a chance node is the weighted average of the various possible value with probability being the assigned weight. Simulation is converting a real-time problem into an imitating a real-time problem in form of a financial model, where you will be given various cash flows, various profits, various data on life. You have the probability, put a total called as cumulative probability, and then fit in random number. You have your random number, which can be given in the question. R in table is given, or they may tell you in exam that you put any random number. It can also be saying that you can put in your own random number. So I put some random number, I look at where does it fit in, I get the cash flow, I get the life, I get the price, I get the cost, and then do the NPV. Highest NPV I'll get, sorry, I'll get multiple NPV, take a simple average of that, take a simple average. And last one is option in capital budgeting, where you have a foundation project which is bad, and there's a new project which could be good, new project which could be good. So I don't want to do the foundation project because it's bad, but the better project is there. So you first analyze the base project, then you analyze the option, club them together. Clubbing them together, if the project is viable, go ahead and do the project. Go ahead and do the project. Clear? Any doubts in this? Okay, let's take a break of 10 minutes and then resume.